Tesla doing some of the damage there. S&P 500, 26 points lower. That's down 0.6%. The Dow Jones Industrial Average, 155 points lower. That is a slide right now of 0.4%. So the winning Mega Millions lottery ticket that was sold in Florida, netting an estimated $1.58 billion prize, largest in the lottery's history. So the winner can choose between the one-time lump sum that's worth $757.2 million, or you can also get 30 payments valued at $1.55 billion. Both of those options are pre-tax estimates. I would take that figure and then just cut it in half.
Yep.
So,
all right. Well, I need money now, dude. And I was so close. So close.
but some of the experts say don't take the upfront lump sum payment.
Oh, yeah? All right, I'll have to talk to my people. See what's going on out
Check
there.
in.
John Tucker, thank you so much. We appreciate it.
Wish I had
Met
those
Paul
problems.
Sweeney in our Bloomberg Interactive Broker Studio. We're also streaming this thing on YouTube, so go over there and search Bloomberg Global News. All right, I got the S&P 500. Well, let's start this way. One of my favorite Tom Trump-isms is the courage to be in the market. And I got the S&P up 16, 17% year-to-date. I got NASDAQ up over 30% year-to-date. Does one have the courage to be in this market? Phil Palumbo, founder, CEO, and CIO of Palumbo Wealth Management. So, Phil, after a disastrous 2022, investors are doing a little bit better this year. A good first, 7 months plus. Now what do we do?
The bigger question for me is, why didn't we get a recession yet, right? So we think about coming into 2023, it was recession fears, now it's recession delayed. And again, why didn't we get a recession? So understanding that, it's going to be important. And in my view, I look at it like there were three acts that happened. There was the American Rescue Act, there was the Infrastructure Act, and then there was the Inflation Act. All of that generated money into the economy for building infrastructure, et cetera, which really created this cushion within the economy, because anybody who's been in business for a good amount of time knows that when you have leading indicators doing what they're doing, when you have inverted yield curve, and you have a Fed who has moved rates up as aggressively as he has, you always have a really bad recession. And we just haven't gotten that yet. So what investors have to understand is that you have to be cautious in the short term because of what I just said with the Fed and all those things that normally precede a recession. But with these other parts that I think a lot of prognosticators missed, which is this money that's been flooded into the economy, deficits have gone up. Deficits up, it's tough to really get a recession because the government's spending. So you can't sit on your hands and just watch the market go up. You have to be active. But these are really kind of the push and pull that's going on today.
So if you look at the U.S. stock market, obviously as a forward-looking mechanism, what is it telling us that investors are betting ahead for the economy?
So investors are betting ahead of two things, right? One is AI. So AI, like we talked about this before, is for real. It'll be productive for companies on the front end, which will expand margins, and that'll be great for EPS as we think about 24, 25, and 26. That's number one. Number two, markets are betting that inflation is going to come down. The Fed's going to be done with raising rates, and because of that, interest rates will come down, and that'll be beneficial to stocks. So that's what market participants are betting on.
So, Phil, we're looking at WTI crude oil up another 1% today, $83.79. Is there an energy play out there you like?
I do. So I like Occidental Petroleum. I like the energy sector just in general. I think the economy here, does seem to be reaccelerating here a bit. And, with that, commodities are starting to improve. You can see it in the pricing from a technical standpoint. So Oxy is a company that throws off really strong free cash flow. And as the price of crude continues to rise, free cash flow becomes that much better for Oxy and many other energy companies as well. So that's a play that I like a lot.
What about Nike?
Yeah, so Nike, as we all know, is a wonderful brand. It's trading below its intrinsic value by about 20, 25%. Recently, it's come down in value from a pricing standpoint. I mean, the return on investment capital on average has been 50% the past 3 years. That's continued to be projected to be at that level or even greater than that. Their EPS has doubled over the past 10 years. The story about Nike is not going away. I love their direct-to-consumer strategy. eliminating the middleman. I think that's really going to work well and be profitable to the company. So we started buying into that about 2 or 3 days ago. We bought about a 70.75% position within clients' portfolios. We will add if there's a continued weakness in that particular area, which may happen as a result of China weakness.
And the latest results that we had from Nike toward the end of June, obviously seeing that sales strength, but this is a very discretionary company. If these are what consumers are going in and buying, especially these niche types of brands, does that really tell us that there's a recession on the horizon?
Yes, I mean, that's the thing. So it's kind of, if you listen to Target and you listen to Tyson Foods and what they're saying, there is concern that the consumer is abating a bit. But if you listen to what Amazon is talking about, which is one of the strongest areas where you're seeing consumers buy, their numbers are very strong. So it goes back to what I said before, the jobs numbers are very strong. If you have a jobs numbers that continue to be strong, consumers are getting a paycheck. If consumers are getting a paycheck, they can go out there and spend money. And that's what we're going to continue to see going forward. A lot of Nike is around China. China's strength coming out of COVID hasn't been as great as many people anticipated. And a lot of Nike's EPS growth we're estimating will come out of China. So we really need to see a strong China for Nike to really work as we think about Nike over the next 3 to 5 years.
We're going to get some inflation data over the next couple of days. Where are you on your inflation watch here for this economy?
It goes back to what you were asking me before about the market overall. So the market overall is anticipating inflation to continue to decelerate and the Fed to pause and be done. I don't know if it's going to be that easy. I do believe inflation has come down quite precipitously from its peak, but I do think we may get sticky because of housing and wage pressures as we think about the CPI prints going forward as it relates to core. And if you take non-core, regular CPI, which includes food and energy, now with energy prices increasing, you may actually see that number disappoint. So, it's interesting. If you look at the 10-year Treasury, it's holding that 4% number. Right now there's a huge short on the 30-year, based on various commentary that we've all probably know about and been reading about. So you see, everybody's waiting for this print tomorrow. I think it's going to be a print that's not going to be good and concern a lot of market participants that maybe the Fed is not done.
We only have about 45 seconds left. You were talking about Occidental Petroleum earlier. I'm curious, when you're seeing this big rebound, especially today in energy stocks, up about 1.5% in the S&P 500, do you think we've gotten to a range where it's a contrarian indicator, especially with the amount of massive outflows we've seen in energy, to where investors are going to come back in and start buying those shares?
Yeah, remember, energy is one of the worst performing sectors year to date amongst healthcare and staples, right? So if we're starting to see an area where there's value relative to technology, consumer discretionary, which are sectors that have performed really well year to date. If you're going to rebalance a portfolio, if there's concerns about inflation, then maybe energy is a place where you want to be. And again, we'll see tomorrow with the print and how that trend's going forward. But I think that's what we're seeing with market participants.
Phil, thanks so much for joining us. Always appreciate getting a few minutes of your time. Phil Palumbo, he's the founder, he's CEO and CIO. I think he's pretty much in charge there.
He's doing it all.
And he's got his name on the door, Palumbo Wealth Management, so that says it all. Still constructive on this market. He's looking a little bit on the energy side, a little bit on the consumer side with Nike. So interesting to get some thoughts there. S&P 500 off 0.7%, so we're seeing a little bit more accelerated selling in this market. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
All Italian banks and their shareholders are breathing a sigh of relief after the government tweaked a tax that wiped out $10 billion in market value for the country's lenders. Bloomberg finance reporter Sonia Cerletti in Milan says bank stocks reacted positively to the changes so far.
We have seen a rebound, but this rebound wasn't able to recover yesterday's loss. We are still halfway, and given that there is still a lot of uncertainty on what will be the final outcome of this law, for sure we will keep seeing volatility and possibly other movements in one sense or another of stocks when further clarification will arrive.
That clarification centers on capping the tax at 0.1% of a firm's assets. Cerletti says analysts are wondering if the cap applies to only Italian assets or total assets at home and abroad. The head of United Auto Workers says no deal to a contract proposed by Stellantis. UAW President Sean Fain, in a Facebook Live video, said the proposal was insulting, given the sacrifices workers made during the COVID-19 pandemic.
Rather than honoring the sacrifices made by the employees, management chose to spit in our faces.
Bain then tossed a copy of the contract in a trash can, saying, quote, "That's where it belongs." And U.S. mortgage rates climbed more than 7% in the week ending August 4th, that jump coming in a week that government bond yields spiked following a surprise decision by Fitch Ratings to downgrade the nation's credit rating. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Jess Met and Paul Sweeney here in the Bloomberg Interactive Brokers studio. Just looking at these markets here, S&P 500, we're seeing the sell-off in the markets accelerate a little bit here, off about 0.8%. NASDAQ off 1.3% here. The VIX, it pushes out again. We're now just about 16.76 on your VIX. Yields a little bit tighter in here, 3.99%, 4% right there on your 10-year. We're keeping an eye on that. WTI crude oil, we're also keeping an eye on that. $83.66. We were up to $84.65 earlier in the session. So oil moving higher. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Morris.
All right, thank you, Paul. Wildfires in Hawaii have burned multiple buildings, forcing people in one tourist town to flee into the ocean. Acting Governor Sylvia Luke has issued an emergency proclamation for the island of Maui. Mayor Richard Bisson says the biggest complication right now is the wind.
It's prevented us from having helicopters assist in putting out the fires just because of the dangerous winds.
The National Guard in Hawaii has been activated to help with those evacuations. A hearing on a proposed protective order in former President Trump's election interference case is set for Friday. The Justice Department recently filed for the order asking the judge to place some limits on Trump's speech about the case. GOP presidential candidate Chris Christie is challenging Trump after the former president made a joke about Christie's weight. Trump spoke yesterday at a campaign rally in New Hampshire.
He's eating right now. He can't be bothered.
The former New Jersey governor fired back with a tweet that said, quote, "If you had the guts, you would show up to the debate and say it to my face." Trump has indicated that he is not likely to participate in the upcoming Republican presidential debate, which is set for August 23rd in Milwaukee. However, now there's a second GOP primary debate on the schedule. The Republican National Committee is partnering with Fox Business, Univision, and online video provider Rumble for the September 27th debate at the Ronald Reagan Presidential Library in Simi Valley, California. And it turns out you might not need to walk 10,000 steps each day to lower the risk of heart disease. A new Johns Hopkins study from Johns Hopkins University studied 200,000 people who were counting their steps, and researchers say it looks like 4,000 steps per day is a pretty good target. Researchers say once you hit that 4,000 step mark, your risk of dying prematurely from any cause goes way down. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg, Paul and Jess.
All right, Amy Morris, just so you know, I'm averaging over the last week 5,880 steps.
It's amazing.
So I'm getting there. But that's nothing. I need to get to 10,000 a day. That's kind of the goal.
It's because you're coming in on the train, though, from the Sweeney compound. It's different when you're living in the city.
I walk back and forth to the train station, but that's not enough.
Just
All right,
not enough.
have to get to work on that.
You'll work on it.
All right, what else is going on out there? IPOs, okay?
Yes.
I think we should see more IPOs. Thank you, Amy Morris. I think we should see more IPOs. But a study from KKR, they did a survey with some buy-side investors. These investors are looking for discounts of 20 to 30% to their listed peers. I never did that when I was pitching IPOs. I said,
No.
we'll bring you spot on top of them, maybe at a premium. What's going on out there?
Yeah, Amy Orr, one of our newest reporters on our U.S. equity team, was taking a look at this and putting this together on the terminal. So IPO investors are putting money to work only at these steep discounts. And so you were talking about that data that KKR had. Investors are looking for a fair value when it comes to upside post-IPO. In 2020 and in 2021, though, IPOs are basically a lost generation that may never recover is what is quoted in this. But looking at some of this data, it's interesting to see sort of how this shapes up when you're looking ahead. And obviously the last year, even more than that, just with the correlation with the Fed and the aggressive interest rate hikes that it's had, and far as how it just sort of dried up that space, but then potentially what it could look like moving forward. We keep talking about, IPOs like Kava. When are we going to go, Paul?
I know.
I thought we're supposed to,
exactly.
we're all going to go. And
I'm surprised we haven't seen more. And, Bailey gives us his learned experience excuse that they want more certainty in the marketplace.
Yeah.
I mean, come on, the market's ripping, stocks are higher. I'd be out there pitching like crazy, and I would bring my companies right in line with the peer comps, maybe even a premium.
We'll have to ask Bailey more about this.
That's how I ran it back in the day, and it worked out okay. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, we've been talking about our MIA colleague, Matt Miller. I think we've located him. In a couple of minutes, he's going to be sitting down with the General Motors president, Mark Royce, talk about GM, talk about the industry, the transition to electronic vehicles. So that's going to be a really smart conversation. Matt will have that in just moments, and we will bring that to you. And we're also going to check in with Ann Hand. She is the CEO of Super League Gaming. She's going to talk to us about the gaming business. We just had a big transaction with, we saw Walt Disney Company get it do a deal with Penn National, so that's important in that space. So we'll break all that down. But first, let's go to Charlie Pella for Bloomberg Business Watch.
Hi, thank you very much. We are looking at an arrow to the right and lower right now for the S&P 500 index, very close to session lows. You mentioned the interview coming up with General Motors, shares of GM indicative of what's happening in the broader market, down now by just about 1.6%. You also mentioned Disney and Penn. Disney shares lower ahead of earnings, down 1.1%. We have got shares of Penn Entertainment rallying today by 6.5%. Bottom line here, though, lower across the board for the Dow, the S&P, and NASDAQ. A slide in big tech and higher energy prices weighing on Wall Street sentiment today. Crude oil advancing 0.7%, now above $83 a barrel, $83.45 right now on WTI. Gold down $8 the ounce to $19.17, a drop there of 0.4%. S&P 500 index down 32, a drop now of 0.7%. The Dow Jones Industrial Average down 212 points, lower by 0.6%. NASDAQ, the composite index, down 159, down now by 1.1%. 10-year yield right at 4.00%, with the 2-year 4.77%. I mentioned Disney after the bell. The report comes a day after Disney announced that its ESPN network has signed a long-term exclusive agreement with casino operator Penn Entertainment, licensing its brand for sports betting and deepening the media giant's ties to the growing online gambling business. Geetha Raghunathan is a media analyst with Bloomberg Intelligence, and she was a guest this morning right here on Bloomberg Markets.
Owning a sports book directly is very difficult. It's fraught with a lot of operational, a lot of regulatory challenges. And so this kind of gives them nice exposure. So it kind of, they're getting that $1.5 billion in cash, the $500 million in stock options. So it gives them, a good exposure without getting directly involved. And it kind of tells us that ESPN, the brand, definitely does have value.
And as we mentioned, Disney shares ahead of earnings, down 1.1%. Penn up by 6.5%. By the way, you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Roblox shares after earnings, they are plunging now by 20.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pella, thank you so much. We appreciate that. Jess Metton and Paul Sweeney, we're here live at the Bloomberg Interactive Broker Studio. We are streaming live on YouTube, so just head over to YouTube and search Bloomberg Global News, and that's where you will find us. And coming up in just moments, General Motors President Mark Royce is going to join Matt Miller, and they're going to talk about GM and cars, which is Matt's favorite subject, so looking forward to that. Again, red on the screen is Charlie just reported. We got at or near the lows of the day, so we've seen some accelerating selling here into the mid part of the day.
Energy's still up more than 1%, though. In
what's
the
that?
S&P 500, the energy sector is still up more than 1%. But obviously, we're seeing those losses driven by technology and communication services.
Yep, absolutely. Bailey Lipschultz, he follows the markets for us. He joins us live here in our Bloomberg studio. Bailey, what are you looking at today?
Yeah, no, we're seeing weakness in a lot of the year's biggest winners. NVIDIA down more than 4%, Meta down 2.5%, as is Tesla. So weakness, Jess, as you mentioned, across technology shares. One thing to note, I know we will have that GM interview, down 1.6%, crossing the terminal about 4 minutes ago, were headlines that GM's Escalade will be Escalade EV, will have a starting price of $130,000. So
nice,
kind of a nice hefty price tag there. But looking at some of the movers and shakers, if you will, we are seeing weakness across DraftKings and Flutter, obviously in the wake of Penn Entertainment's ESPN deal. WeWork, one of the notable underperformers, down more than 35% right now after a going concern warning. Obviously, this is a company, lease obligations, debt obligations, more than $17 billion. Market cap is closer to $280 million. So not a complete shock there for a company that went public via SPAC. And Roblox down 20%. Daily users dropping off. So this was one of the many pandemic darlings that was a high flyer back in 2020 and 2021, but right now trading for about $30 a share. Again, down 21%. Bit of a choppy day, but broadly speaking, volumes on the whole not that high ahead of that July inflation data, which is going to be closely watched.
$130,000, making it one of the most expensive EVs on the market. So I'm guessing, Paul, is that it's not a BMW? So you're thinking
no.
you're
But
not
again,
gonna
thanks to
want that?
Matt Miller hooking me up with his friends at Ford, I did get to test drive that Ford F-150
Nice.
Lightning, the EV truck, and it was awesome. I mean, it had every bell and whistle you could imagine, but it was really powerful, really fast, great torque. I was shocked about how much power it had. So, but it came at a nice price tag of $94,000. I'm like, please,
Are you a fan of buying first generation, second generation things? I feel like I'm more of a wait for the fourth or
I'm
fifth
kind of like
iteration.
Apple. I let other people, do all the hard work, and I'll come in and just right at the end and just make something better. Like
It's
Apple
easier
does.
that way.
Exactly.
Wait till anything wrong with it gets reversed, any sort of recalls. We were just talking about Amy Orr's story, who, Bailey, as you know, is on our equities team and works very closely with you, but she was reporting on that KKR survey about buy-side investors with more than $10 trillion in assets, showing 43% of investors are looking for IPO candidates to provide about a 20% to 30% discount on their listed peers to feel more comfortable about investing. We always try to pick your brain when it comes to IPOs and the outlook, but has anything changed since the last time we chatted with you?
No, I mean, investors want a deal. And buy side, when you look at trading in the likes of Kava, Savers Value, Oddity, three of the better performing bigger IPOs, in quotes, this year, the big thing is getting an allocation at a price that makes sense and makes investors happy. And that's really what you're looking at with this report. A lot of people were more than happy to point to the Renaissance IPO ETF ticker IPO, up 33% this year. But you ignore the fact that it's down still more than 55% from a February 2021 peak. So a lot of investors are still licking the wound, still feeling a bit of a burn from that rush we saw in 2020, the record-setting year of 2021. And that's why you've seen so far this year IPO issuance on U.S. exchanges down about 94% from where it was this time back in 2021. We will see some of those bigger companies, the likes of Arm, Instacart, Birkenstock, and Turo likely this year, but it still is a lot of uncertainty in trying to match up the buy side with what these companies are comfortable selling stock at.
Hey, Billy, what is Axon Enterprise, and why is that stock up 14% today? What do they do?
Axon is the company that makes Taser and body cameras.
Tasers and body cameras. For who?
For individuals as well as police departments.
Oh, okay.
And this is a company that saw their new product, so their Taser 10 and their Axon Body 4 camera.
Nice.
Driving sales well above what analysts were expecting. Needham adding it to their conviction buy list. William Blair coming out basically saying that product innovations are helping it identify new growth opportunities in that cross-sale space, so newer international markets, working with the federal government. This is a stock right now up 15% on some pretty hefty volume, more than 1.6 million shares trading hands. This is the top performer in the S&P 500, and Paul, this is a $15 billion company, so it's not
Never heard of it
small
before.
company.
It's amazing how many companies are out there. They're just, this market cap in this size, and tasers. Who knew?
Taser's, pretty profitable business when you look at their results. And again, a 15% jump looking on the terminal is their best reaction to earnings since 2020, and things were a bit wonky back in 2020. I think we all know firsthand.
All right. Paul, do you have any tasers?
Nothing. No body cam, no anything. But if you think about it, every police force in the country now probably is either has the body cam or is getting the body cam, upgrading to the body cam. So I
do
guess
we know if they do pepper spray?
I don't know.
We should look into
check that out.
I have some pepper spray, not currently on me, but
Oh, you're a pepper sprayer?
I have some in my apartment actually.
Okay.
Yeah.
Cool.
You
Very
never
good.
know.
You never know.
Gotta keep it safe.
Single
Never know.
woman, got to take care of myself.
All right, what else are you looking at, Bailey? Anything else jumping out again?
Celsius Holdings, the maker of the Celsius energy drink, which they say can help you burn fat, according to a couple university studies. I'm a little more skeptical on that, but right now trading at a record up about 20%, strong sales margins, beating expectations. This is a company that right now has a market cap around $13 billion. That compares to probably their best comp, Monster Beverage, which is around $60 billion. So when you're looking at kind of valuations, this rally off the results, really strong, trading at an all-time high, absolutely ripping and beating expectations. But on a valuation basis, this is a stock that, according to the terminal, trades at about 76 times blended forward price to earnings, EV to EBITDA about 44 times. So far above some of those better comps, but you're trading, a beverage maker almost like a technology company, given the kind of area that they can tap into.
Crazy. All right, Belly Lipschultz, markets reporter for Bloomberg News. Thanks so much for joining us, giving us the update here. In just moments, we're going to go to that simulcast. Matt Miller sitting down with the General Motors president. We'll get the update there. I'm looking at GM. The stock is off about 1.4% today, up about 8% year to date, so still lagging the marketplace. It's got a market cap of $50 billion even, but GM, like every other auto manufacturer in the world, pretty much really starting to make that transition from internal combustion engines to electric. And I mean, this is, not being an expert on this, but I would argue this is, the biggest issue that the auto industry has maybe ever had to face in terms of a challenge of really just changing the entire way that you manufacture and the product that you sell. So it's going to be very interesting to see how these companies do it. Of course, Tesla has got that head start, and it's got the big valuation, which they've always had.
Right.
And a lot of these other companies, including the European ones and the Japanese companies, are all trying to catch up and all trying to make that transition. And it's going to be a longer transition and probably a little bit more bumpy. So we're going to go right now to an interview with General Motors President Mark Royce. He sits down with Matt Miller, talk about the company.
Welcome to our Bloomberg television and radio audience worldwide. General Motors unveiling its first all-electric 2025 Escalade IQ. Let's send it over to Bloomberg's Matt Miller, who's sitting down with General Motors President Mark Royce. Matt.
Ed, thanks very much. Mark, we really appreciate you joining us. This is a very powerful vehicle with 450 miles range, but also a very high price tag. Who are you aiming this product at?
Well, if we look at the current Escalade, we sold over 1 million units, and we one out of every 3 of these SUVs in this luxury segment is an Escalade. So we've got a very successful brand. It's been, an unbelievable vehicle for Cadillac and General Motors, but this is additive business. So we know there's people that are wanting an electric 3-row SUV, full-size SUV. We're going to be the first ones to really bring it here with an iconic brand. So we know this is in addition to our internal combustion engine Escalade, and you can see it as the next step in the design language for Cadillac, both inside and out. And so this is going to be, right on the cutting edge of everything. It's the Escalade standard of the world. It really is.
So you already have the Hummer, though, which is definitely on the cutting edge of everything, right? And early adopters who are waiting for a big electric vehicle, I'm assuming went out and got that. Who's left to buy the Escalade at $130,000 to start? Yeah,
I was going to say, well, the Ultium platform here that we're talking about is very flexible, and it's very different than the SUV offered from Hummer. And so you'll see it in the proportions here, where we really are going after efficiency with 450 miles of range. That's a big deal for families and people who travel. So it's a big range vehicle, but it's also 750 horsepower. The Hummers are in the 1,000 horsepower stand, in that part of the market there. So it's a little bit different customer. It's very different from a duty cycle standpoint, but it's still built on the 24 mod pack that we use on our battery electric truck platforms.
There has been some criticism about these big battery packs. Bloomberg New Energy Finance, for example, wrote that you're using a lot of lithium that maybe should be left for the smaller electric vehicles. How do you respond to that?
Well, General Motors is going to make both, number one. So we're going to make everything from the Bolt with an Ultium-based pack here as we bring it back online, to the Equinox, to the Blazer. So those are right in the biggest segments in the world at price points that are, the most affordable, right in the wheelhouse of those big volume segments. So we're going to do that too, but, technology changes, and so anybody that thinks that we're going to have the same technology even a year from now, chemistry-wise, with our battery systems across the whole industry, isn't thinking about it quite right. I think it's been mentioned before that the telecommunications industry, there was all these people that were fearful of copper, right? That all changed, right? And so you get into silicon, you get into chips, you get into all those things that are new technologies on a breaking transformation of the industry. And I can tell you, the history books will see this as just the first step.
All right, we're talking again with Mark Royce, president of General Motors, at the introduction of their Cadillac's brand new EV Escalade IQ. And, I have driven the Escalade, the V, with also about 700 horsepower, right? It's got a big V8, eats up a lot of gas. That's the problem you're trying to solve with this, but there are still going to be people out there who want the V8. How long are you going to sell the internal combustion engine Escalade next to the Escalade IQ?
Well, they're very different vehicles, again, in terms of the package. We've got a huge amount of storage in this vehicle because of what we have up front, where the engine used to be, and then also a longer wheelbase, and the second row package is quite different, too. So you add those things together. They're different vehicles, even though sort of the output on the power basis are similar. We're going to do both as long as people want both. And so, if you look at this over the long-term horizon, the market and the customer, we haven't sold a vehicle like this ever. The market has never seen a vehicle like this. This is the first standard of the world, and so we're going to see what people do.
You are going to bring out the Silverado with, I believe, a similar battery pack and range, at least as an option. Are you seeing price pressure because we're now seeing Ford capitulate and cut prices, Tesla obviously driving that? How do you expect the pricing to work out?
Well, the pricing, we're starting with the Silverado with our work truck. So, our pricing and our ladders and our battery capacity and range capacity and duty cycle capacity on Silverado and Sierra are going to be for everybody's pocketbook and price point. So, we know where people want it from a work truck in our fleet standpoint, and then it'll go all the way up through the RST, which will, again, be a high range, high module, but you don't have to just do that. So we're going to offer those things as options. Cutting price, though, means that we didn't see it right. And I don't think that's true. I think we're right in that wheelhouse of what people can afford and want. And so, I feel good about our pricing.
Are these vehicles going to be profitable when you start selling them?
Yes.
And are you going to be able to make 1 million of them in 2025? Not the Escalade IQ.
No,
I just mean
electric
vehicles.
Yeah, electric vehicles. Yeah, I think so. I think we're well on our track. We did 50,000 here. First half of the year, that was our target, and we did that. You got to bring cell plants along online as you do the assembly plants to make these. Our first plant in Lordstown, Ohio, is now full capacity and running really well. The second one will be in Spring Hill, Tennessee, right next to our Lyric facility there. So that's coming online next. And the third one will be in Lansing, Michigan, and we're just doing the construction on that right now. So once we get past the first plant in Lordstown, Ohio, we learn how to make them. We do it at volume. We duplicate that in Spring Hill, and we duplicate that in Lansing. So the first ones out here, we knew were going to be something that we'd never done before, and we tackled that, and we're doing it with high quality, and we're doing it rate. So those are, that's how you get into volume production.
I got to ask about the negotiations with the UAW. Are you prepared to make an expensive investment in raising those costs? Because their demands are, I think they said, pretty audacious.
Yeah, I can't comment on what people say or don't say about that. We are negotiating with our represented workforce in earnest, as we always do. And we're there to make a good agreement, a fair agreement, an agreement that works for everybody. And that's all I have to say.
Mark, thanks very much for your time. Really appreciate it. Mark
Thank you,
Royce,
Matt. Always a pleasure. Thank
President
you.
of General Motors, talking to us about Cadillac's new Escalade IQ. Ed?
All right, that was Matt Miller talking with the president of General Motors, Mark Royce. That is Matt Miller in his happy place.
Yeah, he is.
Talking cars with car people.
It is his happy place.
Yeah, so they were talking about that. I guess in the background it was an El Dorado,
Yes.
or I'm sorry, the Escalade.
Cadillac Escalade IQ.
Yeah, the E Escalade. That looks pretty sharp back there. But
$130,000 price tag.
$130,000. You gotta be kidding me. All right, good stuff there, and we'll have presumably Matt Miller will find his way back here at some
Eventually.
point. Yeah, we'll be on the lookout for him. Right now, let's go to Charlie Pellet for Bloomberg Business Flash.
Hi, thank you very much. We are looking at a down day right now with the Dow, the S&P, NASDAQ all declining. We just had the interview with General Motors, and GM shares down 1.3%. A slide in big tech and higher energy prices certainly weighing on Wall Street sentiment ahead of that key inflation report, the CPI report tomorrow morning, that will help shape the outlook for the Federal Reserve's next steps. S&P right now down 30, a decline there of 0.7%. The Dow down 196, a drop of 0.6%. NASDAQ down 151, a decline of 1.1%. 10-year yield now at 3.99% with a 2-year 4.76%. Spot gold down $7.50 the ounce to $19.17, dropped there of 0.4%. And West Texas Intermediate crude up 0.2%, $83.12 for a barrel of WTI. Well, as you heard right here on Bloomberg Markets, GM plans to build an all-electric version of the Cadillac Escalade, and it'll come with that eye-popping price tag of $130,000, making it one of the most expensive EVs on the market. Our Matt Miller caught up with GM President Mark Royce moments ago.
This is additive business, so we know there's people that are wanting an electric three-row SUV, full-size SUV. We're going to be the first ones to really bring it here with an iconic brand. So we know this is in addition to our internal combustion engine Escalade, and you can see it as the next step in the design language for Cadillac, both inside and out. And so this is going to be, right on the cutting edge of everything.
And you can hear more of that conversation on the Bloomberg Technology Podcast. You can download it wherever you get your podcasts. Again, GM shares down 1.4%. After earnings, Lyft down 8.6%. Rival Uber down 2.4%. Disney after the bell today down by 1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, how did you get that Royce sound like 15 seconds after?
So fast.
It is the magic of Bloomberg. Listen, we got it's like the Verizon commercial where you see a ton of people in the background. That's what we do here at Bloomberg. We got a big team, and it's a team that works very well together.
All right, Charlie, great stuff as always. I mean, I just want our listeners to know there's a lot of production time and value that
goes into this,
like,
making it look
great.
great.
And how he gets it done like immediately, I have no idea.
Also, it's like Charlie's behind the curtain in, in The Wizard of Oz.
It just happens. I don't know. It just happens. All right, that's good stuff there. Let's continue a little car talk here.
Yes.
Too bad Matt's not here. Detroit Bureau Chief for Bloomberg News, David Welch, joins us. So, David, we just heard Matt sitting down with the GM president, Mark Royce, still sounding really confident in hitting some of their electric vehicle production goals, I think 1 million for next year. This is a major ramp up that not just GM, but all of Detroit is making. What's the feeling about this industry and as it transitions to EV?
Yeah, well, I think a lot of people are skeptical, not just of GM, but just of late. We're seeing weakness in demand for EVs to a certain degree, and that's reflected in pricing. In order to keep volumes up, Tesla's had to cut prices. Other companies like Ford have had to follow suit. Even with price cuts, we've seen Tesla volumes drop significantly in China, so everyone's wondering, well, if so goes Tesla, so goes the rest of the industry. GM itself has had delays in production of its Cadillac Lyriq, one of its first EVs, the Hummer. They had to ground that for a while. They weren't selling them due to a recall, so can they really get to 1 million vehicles next year? And what Royce is saying, you got to listen to GM's words on this carefully. They're saying that they will have the production, and they'll be able to produce 1 million in 2025. They're not forecasting they're going to sell them, and they're not saying they won't either. But I do think they're being a little bit careful about saying that they're going to sell the cars. Having the capacity in place and the battery plants up and running is a big step. But if consumers don't want them at the prices you're going to charge, that's where the risk is. And I think that's why investors are kind of taking a wait and see on the other car companies that are trying to get.
And David, that's kind of where I wanted to go. I guess my question is, why is there not the demand? In how much of it is because of the price? Because we're seeing price tags that no one has ever seen before for a truck, a sedan, and even an Escalade. Just huge increases.
That's right. So like EVs are more expensive than gasoline-burning vehicles, and gasoline-burning vehicles are at all-time highs in pricing right now. Even though they've come down a little bit, they're still really expensive. I think what's going on in the EV market is, and Mary Barra has said this, for the longest time, EVs have been a second, third, fourth car in some affluent family's garage. And it started to get beyond that as Tesla came out with Model 3 and Model Y, but even those were not super cheap vehicles. The Chevy Bolt, Nissan Leaf do sell to people who, it's their only car, but most of the EVs out there and most of Tesla's production goes to people who have a lot of money. And I think you do get to a certain point where there are only so many $60,000, $80,000, $100,000 luxury EVs that the market can buy. And if you want to get past that, past the wealthy people, past the early adopters, you need cheaper EVs, you need more charging out on the highway, and that kind of thing. And we're seeing everybody go to Tesla's charging standard. That gives everybody more access to charging. And then you saw 7 car companies come together to put money, pool their resources and build out on the highways charging infrastructure. So it takes away the fear that you'll be on a road trip and you'll get stranded. And GM and others are coming out with cheaper EVs, but it's going to be a few years. So I think we're sort of like technology always hits. I'm going to geek out on you, an S curve. I think we're at the middle of we're reaching the middle of that S where sales level off until prices come down and everything becomes more accessible for everybody.
Mark Royce also did shrug off concerns as far as when it comes to why a copper shortage would threaten EVs as well as green transition. But innovation in EVs has been seen as denting copper demand's growth potential. How do you view this, and how potentially big of an issue when it comes to copper do you think this could be for EV makers?
Yeah, one of the challenges for everybody going forth with EVs is you're in the commodities market. You're looking for lithium, you're looking for cobalt, you're looking for copper, and you are subject to the price fluctuations, and everyone's going to be competing for availability. GM is one of the companies that's done a pretty good job of forming joint ventures, buying stakes in mines, and securing access to these minerals that'll basically give them enough materials to make the batteries, to make the EVs going out, I think, through 2026 and in some cases beyond. Mark's answer was interesting. He said anyone who thinks we're going to be using the same technology and the same battery chemistry in the next couple of years is looking at this the wrong way. So I think there are a couple of, GM and others, Ford has moved to do this too, and certainly Tesla has. They've got deals out there to secure production of some of these key minerals. But I think they're also looking at all kinds of chemistries where they can reduce the requirements for either expensive or tough to get materials, but they're going to be they're going to be in this game of kind of racing through either innovation or mining deals to make sure they're getting the right stuff at a decent price.
So, is there a sense within DC about how this industry is going to, kind of evolve from internal combustion to electric? Is it because Mark said also that, hey, we're going to continue to make internal combustion engines as long as people want them as well. Is this something that can coexist, or is it a definite phase in, phase out process?
It is, and I think, look, there are going to be people who just don't want to make the transition to EVs in the next 5 years. I think one of the challenges, everyone talks about charging. Okay, there aren't enough chargers on the highway. Some people will resist that. People talk about the price. People don't want to pay that much. Totally true. And you have to remember that, 3/4 of the U.S. vehicle market is used vehicles. Those people absolutely don't have the money to pay for a $60,000 or $80,000 EV, so the prices have to come down. But there's another thing here. People are kind of happy with their gasoline-burning vehicles. And you really have to find a way to dislodge them from that, whether it's just getting them to try an EV. And I've driven some of them on the market. It really is a better experience. I love driving them. But you still have to pull people out of something that right now they're pretty happy with. And that's a marketing and market challenge. So, and it's not going to be that easy for a lot of these buyers. EVs have captured the imagination, and a lot of people are shopping them. But getting the 50% of the market, which is what some of the or more, which is what some of the requirements in Washington are calling for by 2032. I think it's going to be tough given where the consumer mindset is right now.
And to follow up on that, when Matt Miller asked Mark Royce about whether these vehicles would be profitable when they start selling them, when they were talking about the Cadillac Escalade IQ specifically, which has that $130,000 price tag, not surprisingly, he did immediately say yes. And you were just talking about these profitability challenges. What EV makers in this space do you think are maybe better equipped when it comes to sort of these marketing campaigns that you were just talking about versus others that you think might struggle with this?
I mean, look, Tesla, obviously, because they've already got a great brand and they're already profitable here. In fact, they spend very little on marketing because the brand is so great. Look, I think all the major car companies have just big marketing budgets and they can really push this. The question is for them, can they make money on these vehicles? And that was an interesting answer from Royce. I think part of the reason he's saying the Escalade will be profitable out of the gate is it starts at $130,000 and it'll probably go up to $150,000 per vehicle. You can hide a lot of battery cost in a sticker price that big. But look, one thing GM has, and the reason that they aren't selling as many of their newest EVs as Ford. Ford basically took platforms of an F-150 pickup and their midsize, crossover SUV segment, and they converted them, heavily modified them to make the Mach-E and the F-150 Lightning. GM took a step back. They said, look, we don't need to be here now because EV volumes aren't that big. And they made a dedicated EV platform. And the whole idea there was you're basically using the same battery, same platform for the future Chevy Bolt, small vehicle, on up to the giant Escalade, giant Hummer. And they get economies of scale that way. So it's taking them longer to get there. But the plan is that you do get to scale the volume of all your EVs over 7, 8, 10, 12 nameplates over the next couple of years. And they're saying that they will be profitable by 2025. Now, the catch there is, again, they can build 1 million vehicles. If they sell them all, they probably will be profitable. What I'd like to know is how many of that 1 million worth of production capacity they need to sell to be a break even. One forecaster told me they see GM selling about 350,000 in 2025. Would they be profitable there? I don't know. I think it's tough at that point if you're tooling up for 1 million vehicles and you sell a third of that. But that forecaster could be wrong. So sales volume matters, and whether or not they can get consumers to bite on all of this volume, that's what's going to determine their profitability on the programs.
All right. Well, in the meantime, Matt Miller can go test drive a whole new, series of electric vehicles in addition to the internal combustion. So he'll be happy. And I'm sure, David, you do get your fair share of test drives as well. So good luck with that. David Welch, Detroit bureau chief for Bloomberg News. And before that, just commenting on the car business. And again, before that, General Motors President Mark Royce with Matt Miller, and like all the other, most of the other major automakers around the world, all in on electric vehicles. I guess you have to be.
You almost have to be. And especially Matt did interview Ford's CEO actually a couple of months ago. And he was talking about when it comes to the price cuts and the competition, you're seeing a lot of these big automakers, whether it's not just General Motors, but also Ford having to go into this space to compete as well, Paul.
Yeah, absolutely. Volkswagen as well. So it's going to be an interesting thing to experience going forward. But I just want them to bring back the stick shift. I mean, that's all I ask for. I mean, BMW discontinued that in, I think, 2016, 2017. So I have to hold on to my 2014 like forever, because I don't think anybody's going to make it anymore. All right, let's head down to Washington, D.C., World and National News with Nancy Lyons.
Thanks, Paul. An internal Trump campaign memo is front and center today. The New York Times is reporting the previously unknown document details how the Trump team, including the lawyers, hope to overturn election results in 2020. Bloomberg's Washington senior editor Wendy Benjaminson says the memo is quite detailed.
Laying out, let's get the fake electors going. Let's have them vote for Trump instead of Biden. And the Supreme Court will probably overturn it, but by then it may not matter, which is really sort of surprising to hear, lawyers for the President of the United States saying this. And they lay out the plan to request Mike Pence to overturn the election.
Again, Bloomberg's Wendy Benjaminson in Washington. Voters in Ohio have overwhelmingly rejected a measure that would have made it harder to amend the state's constitution. Bloomberg Government's Jonathan Tamari reports the ballot question, called Issue 1, was seen as an effort to block abortion rights, which will be on Ohio's ballot in November.
It's one of the major political forces right now that shaped the midterm in 2022. It looks like it could again shape 2024. Democrats see it as a really powerful issue, and Republicans haven't really found an answer since Dobbs has been, since the Roe v. Wade was overturned. They haven't found a political answer that works for them.
Bloomberg Government's Jonathan Tamari reports turnout was relatively strong for a midsummer special election. The measure was defeated with 57% against to 43% in favor. An aide is confirming Senator Dianne Feinstein, the oldest member in the chamber at 90, was briefly hospitalized after a fall in her San Francisco home. She was released, though, after all scans were clear. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. A bounce off the bottom for the S&P 500 index, now down by 25 points, lower by 0.6%. The S&P now at 44.74. We've got the Dow down 154 points now. That is a drop of 0.4%. NASDAQ, the composite index, down 132, a decline there of 1%. The NASDAQ 100 index down 140, a drop of 0.9%. And the Russell 2000 index of small cap shares down now by 0.9%. 10-year yield 4.00%, with the 2-year yielding 4.77%. Spot gold down $8.50 the ounce now to $19.16, down 0.4%. Bitcoin at $29,665, a drop there of 1.1%. West Texas Intermediate crude oil holding above $83 a barrel now. WTI up by about 0.5%. So what about recession calls, the U.S. economy, and how that is playing into earnings? Kara Murphy is Chief Investment Officer at Kestra Investment Management, and right here on Bloomberg Markets, she spoke with us earlier today.
I would call the recession talk earlier this year as the recession that never was in some ways. But there are a lot of areas of the economy that actually did sort of experience a recession-like retreat. And I would say that the earnings downside that we've seen in the second quarter has been consistent with a small slowdown in the economy.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Carvana is raising its profit outlook as the used car retailer said the momentum it saw from an earlier turnaround is carrying into the third quarter. Carvana shares today, however, are trading lower. Carvana right now down by 3.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pell, thank you so much. We appreciate that. Jess Metton, Paul Sweeney live here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube. You can just head over to YouTube and search Bloomberg Global News. Well, I don't know a lot about the gaming business. Not my gig. Matt Miller's a little bit more into that. But what I do know, the business, is it's kind of like the entertainment business, which I do know. And that tends to be a advertising-driven business and a hit-driven business. You have to keep coming up with good movies that'll put people into the seats.
In-game advertising.
And then in-game advertising is a big thing. So, and apparently our friends at Roblox had a little bit of an issue. The stock's off by 20% here today, one of the big movers. So get a little bit better understanding of the gaming business. We turn to Ann Hand. She's the CEO and chairwoman of Super League Gaming. Is a NASDAQ-listed stock. SLGG is the ticker. Hey, Ann, again, one of the big news items on the tape today is the Roblox earnings. I'm sure you've had a chance to take a look. What did you take away from that? And are you seeing any of those issues at your company?
Actually, it's really the inverse. And I think a lot of this is just because investors, this is a new category for them to really understand. You guys, I heard your intro and you're talking about the fact that about gaming and it being hits driven. You know, game platforms like Roblox are very different than the traditional video games we know and love. So first of all, you guys nailed it. Gaming is at the center of entertainment. It was bigger than the film box office and TV even prior to COVID. But what makes platforms like Roblox different is you don't play Roblox. You play thousands of games inside of Roblox. And what they've done effectively is they've put the tools in the hands to everyday gamers to develop their own game worlds. And so what's powerful about that is that now you've democratized and enlisted, you know, millions of people around the world to make those hits for you and for each other and to enjoy gameplay. And so when I look at, you know, the fact that Roblox is reaching over 65 million daily active users, you know, generating, you know, billions and billions of hours of gameplay each quarter, it's really significant, the amount of engagement. I often say to investors, don't even think of it as gaming. What's so powerful about Roblox is most of the people are there to either create or just to socialize, like a digital cul-de-sac. So think of it as more the next generation of social media. That's just much more highly customizable, personalized, social, interactive. And why that's powerful is it changes the landscape of how you can bring advertisers and brands into the game. So I think that for Roblox, investors should hang in there, because what they're going to see is that the potential for the advertising model to really take off, it's in its nascent days. The best is yet to come.
You did bring up daily active users, so that did fall about 1% last quarter to around 65 million, up though 25% from a year earlier. So still, when you're looking at daily active user count and hours played, that did fall short of Wall Street analyst expectations. But I wanted to gauge your thoughts on this, because Roblox typically doesn't provide financial projections. How much of that goes into the sell-off that we're seeing in the stock today, when investors have a hard time kind of gauging potentially where the company sees things headed?
Yeah, I mean, I do think there's an opportunity for them to paint maybe a more specific narrative around the ad model, because it's significant when you're reaching that type of scale. The other important thing to note about Roblox is their audience is aging up in a good way, because a lot of those under 13 players have now grown into 16, 17, over 18-year-olds, and that really opens up the net even wider for the advertising opportunity. Keep in mind, the primary monetization model has always for them been consumer monetization. And so for them to now add this additional revenue stream, for which Super League is one of their strategic partners in selling off, think about all those eyeballs they're reaching and all the opportunity. I mean, this is like rocket fuel for Roblox. And enlisting a partner like us to do that selling and that monetization for them. But imagine what it does for a small cap company like Super League to have Roblox and that engine and power and reach behind it to kind of help us really accelerate our revenue growth too. So I, again, do believe that while the daily active users felt a little bit flat, the mix is powerful. The portfolio is powerful, and it's still a crazy amount of reach.
And can you define for us what metaverse gaming is, and how big is it? How fast is it growing?
Yeah, it's such an important point, because again, it's so different than the games that I played growing up. I mean, first of all, we've already seen it, that gaming isn't something anymore you grow out of. It's more of a lifestyle, and that's again because these game platforms have changed things. Traditional games that people like Activision and Take-Two make, those are games where they serve a map or a game up to you, and you just play the game, and there's different strategies, but it's not something that you can modify and adapt. What's so different about Minecraft, Roblox, and now Fortnite, made by Epic Games, is that what they're really doing is handing out the tools to empower other people to make experiences. And when I say experiences, it's not, most of the times, it's not about points and winners and losers. It's experiences like a pop-up concert, or maybe you can tour through a museum. Today, the AP just put out a story about how Super League has been enlisted to recreate Hamilton inside of Roblox. So you can now go and you can experience Hamilton, and you can learn about American history in a very gamified way. And so the important thing, again, just to denote is that 2D and 3D metaverse worlds, or these game platforms, are much more, as I said earlier, like an extension of someone's physical social life. And everything that you can do in the real world, you can have a digital twin of. And so I really think metaverse games, people need to think super broadly, because again, it's not just about competition and winning and losing. It's much more about taking your physical life and having an expression of itself digitally.
We only have about 40 seconds left, but how can advertisers use the metaverse as an additional marketing channel to make money?
Yeah, so that's what's so important. When you look at what we did when we recreated Barbie's Dream House in October last year, we drove 60 million visits to Barbie's Dream House. That's powerful engagement. And the average dwell time was about 7 to 8 minutes. Similarly with Chipotle, we drove one of their highest digital food sales days and their highest digital app sale day by allowing first people to experience a pop-up Chipotle in an immersive world, and then that converted them into digital app downloads and food sales. We gave out 130,000 free burritos in real life in 30 minutes. So This is the new way for brands to find this next generation. They meet brands for the first time, 47% through digital screens. So that's where they need to be.
Powerful stuff. Really appreciate getting some of your time. And that's Ann Hand, CEO and chairwoman of Super League Gaming, talking about metaverse of gaming. I mean, it's getting more and more immersive Interesting stuff. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, shares of WeWork continue to tumble, down more than 36%. More from Bloomberg's Abigail Doolittle.
This company was founded back in 2010 on the idea that they would lease big areas of office space, then rent them out to the smaller player that wanted to have a shingle. They expanded in a huge way. Well, now, yesterday, they talked about the idea that they have substantial doubts about whether or not they will be able to stay in business. It was an expansive trajectory, too. In 2019, they were actually the biggest leaser of office space in New York and London. They occupied millions of square feet, not just in New York and London, actually, but in dozens of countries.
Thanks, Abigail. Disney stock is down less than 0.5% ahead of the entertainment giant posting quarterly earnings after the bell. Bloomberg's Lisa Mateo reports.
Steve, the big concern for investors is about CEO Bob Iger's plans to restructure Disney's massive broadcast and cable TV operations. They'll also be looking at how many subscribers Disney added to its Hulu, ESPN Plus, and Disney Plus streaming TV services, and when the company will finally be profitable. Continued strong numbers are expected in its theme parks and cruise division. Steve.
Thanks, Lisa. Verizon is raising prices on its wireless plans for the third time in 2 years. It's part of the company's effort to boost revenue and offset a slump in subscriber growth. Starting in September, customers on the provider's Mix and Match plan will pay $3 more for single lines and $5 extra for multiple lines. Rival AT&T recently raised the price of its top-tier wireless plan by $2.50 a month. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
It just meant Paul Sweeney, and it's some interloper as well. Madison Mills in our Bloomberg Interactive Brokers
So
studio.
excited.
It's a party in here.
group's
Looking
all
at the
back
markets,
together.
I mean, not a party out there in the markets. S&P
No.
off 0.5%, the NASDAQ off 1% here. Looking at yields, 10-year Treasury off just a little bit, sitting right at 4% for your 10-year Treasury note. Not a bad place to be for a lot of folks. WTI crude oil giving up some of its earlier gains. Now just up a fraction here. We're $83.15. We were above 84, pushing up to 85 earlier in the session. So we'll keep an eye on that. So big moves again in the energy markets. Right now, let's head down to Washington, D.C. We'll get rolled in national news with Nancy Lyons.
Thanks, Paul. A newly released memo obtained by the New York Times shows how former President Donald Trump and his allies sought to overturn the results of the 2020 election using fake slates of electors. Greg Valliere with AGF Investments tells Bloomberg this memo should concern the Trump legal team.
You can make a case for a conspiracy that one of these 6 alleged co-conspirators had a big role in this. And I think if a conspiracy case looks more likely, you have to ask the question, could 1 or 2 of those 6 cop a plea?
That's Greg Valliere with AGF Investments. We're also just learning that special counsel Jack Smith obtained a search warrant for Twitter to turn over information on former President Trump's account. This is according to court documents. Ohio voters have overwhelmingly rejected a measure that would have changed the rules about how the state constitution can be amended, which would have impacted the future of abortion rights in the state. We get more from Bloomberg's Amy Morris.
The question on the ballot was Issue 1, requiring a supermajority to amend the state constitution instead of a simple majority. It also would have made it harder for citizen-initiated amendments to reach the ballot. Critics say the only reason Issue 1 was put to a vote was an attempt to make it harder to codify abortion rights protections in the Constitution. Supporters say they were trying to stymie wealthy special interests. Issue 1 was defeated 57 to 43%. President Biden called it a win for democracy. Amy Morris, Bloomberg Radio.
American nurse Alex Dorsonville and her daughter have apparently been freed nearly 2 weeks after being kidnapped in Haiti. The aid organization Elroy Haiti says the two are safe and filled with gratitude and immense joy. The U.S. State Department is thanking its Haitian and U.S. interagency partners for facilitating their release. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Jess.
Thank you, Nancy. We appreciate it. Jess Mitten, Paul Sweeney here, and Madison Mills in the Bloomberg Interactive Brokers Studio coming up on Sound On shortly. So excited to have her here as we finish this last fill here with this story on the terminal that I sent Paul. AI tries to flirt, lie, and even mimic you to find your next date. I don't know. I don't think this is really something I'm looking to do here.
I mean, you swipe left and right. You're of that generation.
I don't use the apps. I don't use the apps.
You don't use the apps.
No, I am of the generation. However, I'm moving against the current. I don't like to use them.
Well done, Jess.
Are you a swiper left or right person back in the day?
I have been on the apps for about a decade, I would say. So I've got some experience.
How rough was it?
And let me tell you something. I would take a bot doing it over myself any day.
See,
the amount
that's
of
what I thought.
turmoil I've gone through, let's outsource it.
Okay.
All right, market it as AI powered. Why not use that term? A fresh crop of dating apps try to make it easier to find the right match by letting a bot assume the job of small talk or pick out someone attractive enough. I mean, go figure. All right, in my day, you went to the bar, you worked your mojo, and you hoped for the best. That's how you do it.
It's rough out there, Paul.
I don't have mojo. That's what I need the AI for. You know what I mean?
One app just lets people date the AI.
Oh my gosh.
The tech is a little wackier than the current swipe left or right apps such as Hinge, Tinder, and Bumble, which have used algorithms for years to serve up results to users.
This is what it's come to.
You guys. Good luck to you guys.
Thanks.
It was much safer back in the day, I think. So.
I bet it was.
But you get AI into it, and everybody gets all fired up, and maybe get the stocks moving.
Change the world.
All right, Sound On with Madison Mills. That starts right now.
1%. Chip makers leading the declines today. So tech is leading the fallers. NYMEX crude is one of the reasons that we're seeing losses in other parts of the market. Higher oil prices are pressuring some stocks. You can see that we're looking at West Texas Intermediate trading right now for $83.48 a barrel. And the U.S. 10-year yield falls as investors buy that paper now ahead of the auction. Right now, 4.0021, and we'll get the results, as I said, in just a moment. Also, General Motors has unveiled its first all-electric Cadillac Escalade. It's called the Escalade IQ for 2025. I caught up with the president of GM, Mark Royce, about the announcement.
The current Escalade, we sold over 1 million units, and we one out of every 3 of these SUVs in this luxury segment is an Escalade. So we've got a very successful brand. It's been, an unbelievable vehicle for Cadillac and General Motors, but this is additive business. So we know there's people that are wanting an electric 3-row SUV, full-size SUV. We're going to be the first ones to really bring it here with an iconic brand. So we know this is in addition to our internal combustion engine Escalade, and you can see it as the next step in the design language for Cadillac, both inside and out. And so this is going to be, right on the cutting edge of everything. It's the Escalade standard of the world. It really is.
So you already have the Hummer, though, which is definitely on the cutting edge of everything, right? And early adopters who are waiting for a big electric vehicle, I'm assuming went out and got that. Who's left to buy the Escalade at $130,000 to start?
Yeah, I was going to say, well, the Ultium platform here that we're talking about is very flexible, and it's very different than the SUV offered from Hummer. And so you'll see it in the proportions here, where we really are going after efficiency with 450 miles of range. That's a big deal for families and people who travel. So it's a big range vehicle, but it's also 750 horsepower. The Hummers are in the 1,000 horsepower stand, in that part of the market there. So it's a little bit different customer. It's very different from a duty cycle standpoint, but it's still built on the 24 mod pack that we use on our battery electric truck platforms.
There has been some criticism about these big battery packs. Bloomberg New Energy Finance, for example, wrote that you're using a lot of lithium that maybe should be left for the smaller electric vehicles. How do you respond to that?
Well, General Motors is going to make both, number one. So we're going to make everything from the Bolt with an LTM-based pack here as we bring it back online, to the Equinox, to the Blazer. So those are right in the biggest segments in the world at price points that are, the most affordable, right in the wheelhouse of those big volume segments. So we're going to do that too, but, technology changes. And so anybody that thinks that we're going to have the same technology even a year from now, chemistry-wise, with our battery systems across the whole industry, isn't thinking about it quite right. I think it's been mentioned before that the telecommunications industry, there was all these people that were fearful of copper, right? That all changed, right? And so you get into silicon, you get into chips, you get into all those things that are new technologies on a breaking transformation of the industry. And I can tell you, the history books will see this as just the first step.
You are going to bring out the Silverado with, I believe, a similar battery pack and range, at least as an option. Are you seeing price pressure because we're now seeing Ford capitulate and cut prices, Tesla obviously driving that? How do you expect the pricing to work out?
Well, the pricing, we're starting with the Silverado with our work truck. So, our pricing and our ladders and our battery capacity and range capacity and duty cycle capacity on Silverado and Sierra are going to be for everybody's pocketbook and price point. So, we know where people want it from a work truck in our fleet standpoint, and then it'll go all the way up through the RST, which will, again, be a high range, high module, but you don't have to just do that. So we're going to offer those things as options. Cutting price, though, means that we didn't see it right, and I don't think that's true. I think we're right in that wheelhouse of what people can afford and want, and so, I feel good about our pricing.
Are these vehicles going to be profitable when you start selling them?
Yes.
And are you going to be able to make 1 million of them in 2025? Not the Escalade IQ.
No,
I just mean electric vehicles.
Yeah, electric vehicles. Yeah, I think so. I think we're well on our track. We did 50,000 here. First half of the year, that was our target, and we did that. You got to bring cell plants along online as you do the assembly plants to make these. Our first plant in Lordstown, Ohio, is now full capacity and running really well. The second one will be in Spring Hill, Tennessee. right next to our Lyric facility there. So that's coming online next. And the third one will be in Lansing, Michigan, and we're just doing the construction on that right now.
That was my interview with GM President Mark Royce. We were down on Spring Street in Lower Manhattan. While you were watching that, you might have noticed some of the headlines on the auction for 10-year treasuries. We've been anticipating this. We had a 3-year auction yesterday. There's a 30-year auction, I believe, tomorrow. Bloomberg Intelligence interest rate strategist Ira Jersey joins us now to talk about, Ira, I guess, first the success of this current auction and how much are we expecting in total to be auctioned this week?
Yeah, so there's $103 billion, Matt, of total coupons that are going to be auctioned this week on a gross basis, which is not quite a record, but it's up there and much higher than what a lot of us thought going into the refunding announcement last week. Today's auction was actually pretty decent. It came in more or less where traders thought, right at 1 o'clock, just under 4%. Importantly, and I think this is the thing that's maybe shocking or maybe going to give some relief to people who are worried that the supply wouldn't be taken down, is that indirect bidders, these tend to be end users, investors, bought 72% of this auction, which is the highest in basically this year. So pretty strong auction overall, not spectacular, but I think it can alleviate a lot of fears.
Are you still concerned about tomorrow? Because I know that you were less concerned about the shorter end yesterday, the 3-year. Obviously today's in the middle, but tomorrow we get the long end auction.
Yeah, so that's really going to be the test of how much duration or market risk that investors want to take. So tomorrow could be much different than today, one way or the other. With yields where they are kind of 4%-ish, a little bit over 4%, there are some investors like pension funds and insurance companies that need this kind of yield and want to lock that in before we might get a slowdown and potentially lower interest rates in the future. So there's going to be a push and pull. There's going to be, will there be a buyer strike? I think we were worried that the bond vigilantes would come out, but I think maybe the repricing that we had last week after we got the supply announcement maybe set up these auctions to go okay. So that's the reason why the auction is okay now, but only because we've sold off 20 basis points from last week.
In terms of total supply this year, Ira, what are we expecting? Over $1 trillion from the Treasury? How can you unleash that much supply without satiating the market?
Well, it's interesting. So it's $1 trillion just this quarter, Matt.
This quarter,
and just this quarter, yeah, it would be a little bit over 1.5 trillion for the calendar year. The way that most of that happens is because of T-bills, right? So one of the things that happened earlier this year and in the spring because of that debt ceiling, craziness that Congress put us through in April and May, is the Treasury Department actually reduced the amount of T-bills outstanding by hundreds of billions of dollars. Now they're replacing them, and then on top of that, they're increasing that supply a little bit. So it's there is this concern, and I Matt, I think that's the answer. The question that still needs to be answered. This isn't the last time that the Treasury Department is going to be increasing auction sizes. They're going to continue to be increased over the next 5 months, and as you get more and more of that supply, will there continue to be this demand? Remember, this is only the first time that the Treasury Department's increased issuance in a couple of quarters. So actually, in a couple of years. So until we get through all of this supply increase, will there be the demand to take it all down? Now, based on today's auction, yesterday's auction, the answer is yes. But as time goes on, we're going to have to continue to see an increase in demand just to meet this additional supply.
All right, Ira, thanks so much for joining us. Ira Jersey, they're our chief rate strategist for Bloomberg Intelligence, talking to us about the auctions that we're all watching so closely and will continue to. Mike DePass of Citadel is going to join us next to discuss the company's trading business and the rates picture as well. Bloomberg Shanali Bastick is going to come back and join us for that conversation. This is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg Markets. I'm Matt Miller. On the heels of that Treasury auction, let's discuss the state of rates and trading rates with Michael DePass. He is global head of rates trading at Citadel Securities, which is one of the largest intermediaries in the Treasury market. And Bloomberg's star Wall Street reporter, Shonali Basak, joins us as well. Mike, thanks so much for coming on the program. First of all, tell us your thoughts of this amazing deluge of supply that we're going to get. I was just talking to Ira Jersey about the fact that more than $1 trillion is going to come this quarter. Is there enough demand for that?
Yeah, thanks for having me. I think there are a couple of things to consider when you look at the supply that's coming. First off, it's obviously very significant. The first concern would be, is there going to be a crowding out effect? Is it going to suck capital away from other asset classes? That doesn't seem to be the case at the moment. You look at credit spreads, they remain very tight. So that doesn't seem to be a concern. I think as we continue to progress and the Fed continues to unwind its balance sheet, there is some concern around the intermediation capacity that exists in the market. Is there enough intermediation capacity to help absorb this supply? And I think that's where there are a number of changes that could be made to the Treasury market that can really help with that. I think central clearing, a move towards greater transparency. Mm-hmm. So there's some challenges ahead for sure.
But what about the idea here that the Treasury Department has consistently increased the size of these issuances, the size of how much they're going to borrow, really not only a couple months, this could go the next 6 months or so. So how much are they testing the market? And at what point does some of this calm start to break? Yeah,
it's a good question, and we haven't seen it yet. So the supply is being absorbed for now, and these things don't happen, they tend to happen overnight, right? I think similar to the QT argument last time when one of the comments was like, it's going to be like watching paint dry. These are one of these things that seem to be smooth until it's not. I would say for now the market seems well equipped to handle it, but we have to be cognizant of the fact that that may change quite quickly.
You know, you look at the 10-year and there is some cooling here, but do you think that that is going to be consistently the direction of travel for yields, or is there going to be more shocks to the upside?
Yeah, the macro environment is fascinating. It truly is. And you have very credible arguments being made on both sides for both higher rates and lower rates. The argument for lower rates would be, we've seen inflation come well off the highs. There's been a real softening in some of the sentiment data. And historically, the economy hasn't been able to handle interest rates at this level for an extended period of time. The other argument, which I frankly find much more compelling, would be the labor market remains structurally tight. Housing seems to have bottomed. You look at fiscal policy, it remains quite expansionary, and they don't seem to be any significant imbalances in the economy. So I think the idea of higher for longer is really what plays out. And when you look at what's priced into the bond market, we have 150-ish basis points of cuts priced in for next year. That seems inconsistent with that higher for longer narrative.
When I look at the argument between Bill Dudley, for example, and Morgan Stanley, there seems to be some debate about whether or not the term premium is correct here. What do you think it should be?
Well, it's an interesting question. I think the big challenge for the market now is not only the amount of term premium, but really what's the neutral rate of interest. And I think there are a number of factors contributing to an environment where the neutral rate of interest is likely higher than it was certainly pre-2008. And I think that's the biggest driver for the market right now.
You started to kind of talk about intermediating concerns here. Is that another way to say that liquidity is going to be drying up pretty soon?
Well, one way to look at it is what is the overall size of the Treasury market relative to the balance sheet available for intermediation, right? And the size of the Treasury market obviously continues to grow, and the amount of intermediation capacity in the system is not expanding. So at some point, does that become a concern?
Well, how big can you get? I'm curious about Citadel Securities' business because, you know, it's very clear that you're neck and neck with the banks. How big have you gotten?
Yeah.
And who are you taking that share from?
Yeah, so for us, the institutional business has really been a big focus of for us over the recent years. I think if you take a step back, you look at Citadel Securities as traditionally being a retail market maker. Over the last few years, we've really transitioned to having a very strong institutional presence as well, and that shows up in fixed income space. And for example, in the last quarter for our Treasury business, we actually saw the most amount of volume out of all the dealers on the street. So a really significant milestone for us. And you look at another institutional business like our equity options business, that's where we're continuing to push, where we're continuing to grow. And I think the success that we've had really comes down to the fact that we are committed to being a market maker. That is who we are as a firm. That's our DNA. And I'm not sure that our competitors feel the same way. I'm not sure they have that same level of intensity and focus on market making that we have, and that's really what's enabled us to differentiate ourselves.
Does regulation squeeze the banks and allow you a more open door in?
I don't know that it's a regulation argument. I think it's really a commitment to processing flow. I think what you're seeing from some of our bank competitors is a bias towards fee business. For us, we want to be a market maker. That's who we are. That's the space that we exist in. That's where we look to excel.
By the way, when I think of market makers, and I think Shonali would agree, I think of people in New York. I think of people in Chicago. But increasingly, Wall Street is moving south, and Citadel kind of has led that move. Is your business also moving down there?
We're in New York for now. I think for us as a firm, having a global presence and having a global institutional presence is very important. We have offices all over the world, but for us as a rates trading business, New York is the hub and will be for the near term.
Humor me here for a minute because everyone knows I've been kind of on this basis trading, walking down that line for a long time now. There's a lot of concerns building in this trade in the market. Regulators are even looking at it. I mean, how concerned are you about the dynamics between the futures and spot arbitrage that has been building with a lot of leverage, frankly, in the system?
Yeah, I would say that the basis trade plays an important part in terms of fostering liquidity within the market, right? The trade is attempting to correct dislocations. Capital is being put to work. Balance sheet is being put to work. It helps with the liquidity. It helps with the intermediation of flow and of the market. They are, again, certain components of the market that could be improved when you look at central clearing, for example, but the basis trade in of itself is a critical part to a healthy functioning market.
By the way, you've been in this business for almost 2 decades, right? You left Colgate in 2006. We have seen amazing leaps in technology, and I'm thinking about AI right now, since then. Is that something you can use in your business as you're running this rates trading business? Can you put AI to work?
I think over time there's certainly a place for it, and I think for us as a firm, what we really focus on from a technology point of view is how can we utilize technology to become more efficient and more effective. There's always going to be a need for humans in this business. It is a relationship business, but how do we get our humans, our human traders, our human salespeople to focus on higher order, higher quality initiatives, and that's really where the focus is.
Very cool. Michael, thanks so much for coming in.
Thanks
really
for having
appreciate
me.
it.
Thank you.
Michael DePass there from Citadel and Bloomberg, Shonali Bassick with us as well. Still ahead, Rivian's CEO doesn't see a need to raise capital before the end of 2025. More on that company as it reports its results. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
One of the challenges with where our plant is located is physically in the middle of the country, and there's not a lot of large markets immediately adjacent to it. And so as we're ramping, we have vehicles that are coming off the line, being produced, and then they get loaded onto rail cars, and that inserts many weeks of time between when the vehicle leaves the production plant to when the vehicle is delivered.
Some of the R.J. Scaringe interview, the Rivian CEO interview from Bloomberg Television earlier today. You can check that out on Bloomberg.com in its entirety. By the way, shares of Rivian are lower as it expects ongoing losses to continue despite an uptick in its production target. Let's talk about this and more with our Bloomberg Detroit bureau chief, David Welch. He joins us there out of Motown. David, first off on Rivian, they won't need to raise capital. How does their production look? Have they put the supply chain issues behind them?
Look, they say they're going to go from a target of 50,000 to about 52,000. It's good that they're not pulling back on production and that they'll hit the targets they initially set and a little bit more, but that's not really pushing out a lot more. And I think that's what investors are looking at when the shares are trading down is you're talking about a company that is still losing money. The CEO, I heard him say that there's a clear line of sight to profitability, but it's not anytime soon. And they're selling expensive pickup trucks and SUVs. It's not a very big market for them. It's not a big market for anyone right now. So how quickly can they get to profitability and to the point where they're cash flow positive? when they're talking about not raising money between now and 2025, it still doesn't say that they're going to get into the black and really be able to stand on their own without raising money beyond then. So I just think it's a long horizon to profit and cash flow positivity for them, and investors are kind of taking a wait and see attitude toward the stock.
We're seeing all these new EV startups, and some of them, I mean, you could even count Tesla among those, but it's making now 2 million vehicles a year, right? I guess some people think this year. How many do you have to make to be a viable, sustainable car maker?
As an EV maker, let's look at what General Motors is saying, and keeping in mind that GM has this other huge infrastructure for all the non-EV parts that's already at scale, like brakes and suspension parts and metal stamping, all that kind of stuff. GM says they're losing money on their EV programs right now, but they will be profitable in 2025. To get there, they need to be making 1 million vehicles, which is their goal. And they say they will also be able to match the profitability of their internal combustion vehicles, but only with thousands of dollars per vehicle in subsidies from the Inflation Reduction Act. So, but let's just say to get profitable, you need to be at roughly 1 million, according to GM. But GM has the advantage of already having this huge infrastructure of part suppliers and all other plants feeding into their assembly, so they can scale up and make money. So look, you're talking about a lot of volume for any of these guys, and it's probably years away.
All right, David, thanks so much for joining us. David Welch is our bureau chief out of Detroit on a day when there's a ton of car news. We have the Rivian CEO interview. I just interviewed Mark Royce, the president of General Motors, and it's just a lot of high-price electric vehicles coming out, and the demand for those seems high because there's not a lot of supply. The question is, when are they going to be able to bring the prices down for your everyman to be able to afford them and to make more than $1 million a year? Coming up next, we're going to talk to the CEO of energy drink company Celsius. Joins us to discuss earnings and growing competition.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
DOJ or other authorities
could face bigger challenges.
Hanson's next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
To be okay is getting ready to make
This is Bloomberg.
I'm John Oakman. Welcome to Bloomberg Markets.
I'm Matt Miller. Let's get a quick check on the markets right now. We're seeing big drops on the day. The S&P 500 is off about 1/3%, so coming well up from its session lows. The NASDAQ had been down 1%. You're seeing the U.S. 10-year yield right at 4 even, pretty much 4.0021. It's been down below 4. It's been up above 4. The dollar index coming back down again, but it's had a great run up, holding at 12.30 right now. And you're looking at oil rising another 54 cents a barrel today to 83.46. It's really oil, John, that's putting some pressure on at least the U.S. markets today. I know markets that have more oil producers are getting a lift from that. And, of course, chip makers are bringing us down because tech is leading the way off.
Yeah, it's a great point, Matt. I mean, here in Canada, our benchmark TSX higher on the day because energy stocks are outperforming. Tech stocks, though, have been struggling on both sides of the border, and you referenced that. And I think since we are still in earnings season, and these are the companies people were looking at to see some growth in their portfolio, the growth outlooks from some companies were disappointing, whether it's a Lyft right now down 9%, Roblox with some of the trends on their user numbers, Bumble, obviously a stock that is also struggled today. Matt, also Nuvei, which is a digital payments company here in Canada, trades in New York as well with a disappointing outlook. And then, of course, we're interested in the outlook from Disney, set to report those quarterly results after the bell tonight. And outside of the bottom line and top line performance, there's just so much to think about, whether it's the possible divestiture of some key assets down the road or what's happening with Disney Plus and their willingness to do streaming deals going forward. So a lot on the agenda when it comes to Disney.
Absolutely. We're going to talk about that a little bit more right now with Bloomberg's Abigail Doolittle. She's taking a look at the stock and the performance. Abigail, what do you got?
Because even before we talk about earnings, Disney today coming out with a big announcement, perhaps as a little bit of a smokescreen ahead of earnings. I'm not quite sure. But in any case, Disney and Penn National, they have struck a deal. So Disney is essentially getting into the online sports betting. They will receive over 10 years about $1.5 billion by lending their Disney betting name to Penn National. Now, it's interesting. Earlier, Disney had been up more than 1% on this. It seems investors are now getting nervous ahead of earnings. Penn National, though, higher, and DraftKings, a competitor to Penn National, clearly down. So let's dig into a little bit more into the Disney earnings. I think that John really nailed it in terms of the surface numbers really don't matter all that much. Although when I say that, I get a little bit nervous because sometimes when people are so focused on everything else, there is going to be a miss that will weigh. But what folks are really looking for, and a piece of this is because expectations are so low, they want to know what is Bob Iger planning around the media assets. They will also want to know, have an update on the $5 billion roughly cost-cutting plan, the execution of it, where are they with it? But relative to those media assets, what are they going to be saying about ESPN, Disney Plus, Hulu, some of the movie flops that they've had, linear TV? There's a lot to unpack there, and I've been informed by some analysts that they don't even need to give a plan. Bob Iger does not even need to give a plan on the media assets tonight, but to simply give a plan for a plan. There's an investor day in September, so that would make a lot of sense. And then interesting, because I often right now don't really think about the parks so much with Disney with the media piece, but parks, that's really the key to the operation. It's about 30% of revenue, 35% of revenue, but 70% of profitability. There are some signs, some early recent reports that there may be some weakness there, that the revenge traveler, leisure traveler, well, they're not so much there. One other thing that we'll be looking for, John, is, of course, a succession plan to Bob Iger. When Bob Iger first joined Disney back in 2005, the stock, until the time that he left the company back in 2020, up 605%. Well, he returned November of last year. It's now down about 10%, but over this entire time period, John, up about 255%. Not so shabby.
Helpful context. Abigail will be watching all of those issues. And as Abigail was mentioning, there are a number of challenges that Bob Iger is facing right now. Earlier, Michael Nathanson commented on that tough task.
just has to work on trying to figure out why they misfired so much on the film side. Maybe changing some leadership there. He has to work on getting ESPN some new partners, as you talked about, maybe finding a partner to invest in ESPN and potentially getting that off his books. He needs to then figure out what to do with his cable networks. Maybe he needs to sell those as well. And he has to work with Comcast to buy in the Hulu 33% stake that is coming to him next year. And he has to worry about DeSantis in Florida. His checklist is enormous.
Absolutely a ton of moving parts there. Bloomberg's Paul Sweeney joins us now to discuss. He covered the media for decades on Wall Street and now does it for us here at Bloomberg. Paul, so much on Bob Iger's plate. Where do you start? What's the first thing you care about him saying?
Yeah, Michael Nathanson just nailed it here. I mean, there's so much to do here. I think he's got to deal with a couple of things right up front, and one of them is ESPN. It was the profit generator for this company for decades. Because of cord cutting, it no longer is. So they had to make a very critical decision, and I think sooner rather than later, what to do with ESPN. Do you make it a pure streaming service and go right over the top? And if you do, how much is that going to cost you? Or number two, do you find maybe another owner for ESPN? That was once unthinkable, but now it is very much front and center because,
when you say that, and Michael kind of said that as well, does that mean selling ESPN?
It very well could mean selling ESPN. It could mean probably more bringing in a partner. And Bob Iger even floated the idea of bringing in a major sports league like the NFL or the NBA as potentially a partner there to kind of, again, as Michael Nathanson said, get it off Disney's books.
And Paul, you alluded a little bit to this, but the reality that for Disney, and the Bloomberg intelligence team was talking about this today, for Disney, if they were to wade into all of this on their own, the regulatory hurdles, especially with what they want that Disney brand to represent, may have been challenging, even though the market is very much going towards sports betting. So you have, I guess, a pairing here that serves some of Disney's needs.
Yeah, I mean, sports betting is just one of the fastest growing parts of the gaming business, period. And it's, we have a number of states where you can do live sports betting. Of course, the mobile sports betting has just been an extraordinary growth story. Disney really needs to get access to that business. Yet, as you mentioned, it is Disney. It's Mickey Mouse. You have to be careful about what you do with that brand. So maybe partnering with a third party like they did here, it brings in some cash flow, which they need. It monetizes some of the value of the ESPN brand, but it gets you access to that fast-growing business. They've already incorporated sports betting into a lot of their ESPN programming, but this is just a bigger step into what is a very fast-growing market.
And Paul, I guess the other factor here is when you've got so many sports rights changing hands and so many, call it technology companies that are also interested in that business going forward, this idea of more partnerships, I mean, is that a possibility outside of, selling assets or acquiring assets? The idea of more partnerships in a fast-changing world is a possibility for Disney?
I think it is. And as recently as 4 or 5 years ago, we would not have said that. But the fact is, cord cutting continues to be a major headwind for all these cable networks, including ESPN. So that pressures their revenue, but at the same time, their biggest cost, which is programming, mostly sports rights, that continues to go through the roof. So that's a tough economic situation there. So to the extent you can shoulder some of that with a partner, I think even Walt Disney would consider doing that.
All right, Paul, thanks so much for joining us. Paul Sweeney walking us through what to expect from Disney. By the way, you can watch and listen to me and Paul every single day from 10 a.m. to 1 p.m. It's streamed live on YouTube and on Bloomberg. You can check it out on Bloomberg Radio as well. You can listen to us. Coming up, the CEO of energy drink company Celsius joins us to talk about the stock. It is soaring in today's session. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets. I'm John O'Lickman with Matt Miller. Time now for our stock of the hour. Shares of Celsius are taking off today, hitting a record. Big move for this stock. The fast-growing energy drink maker reporting strong quarterly results. And one analyst at Piper Sandler sees a long runway of growth, thanks in part to last year's partnership with PepsiCo, which acquired a stake in Celsius, Matt. And they talked a lot about that partnership on their conference call today.
Yeah, absolutely. Taking what is an equivalent to, I think, an 8.5% stake in a deal with convertible shares, or convertible bonds into shares. Let's talk to the CEO of Celsius right now, because the stock is absolutely soaring again today. John Fieldly joins us to talk about the success of the drink and how it translates into earnings and the bottom line. John, thanks so much for your time. Tell us first about the setup, the financial setup for your earnings picture.
Yeah, no, Q2 was amazing. Q1 we broke 200 million in revenue, and then Q3 we just broke 300 million, 112% increase from last year. I think what's really impressive, we exceeded not only our first quarter of this year achieved 200 million, but all of 2021 we did about $300 million. So we just delivered all of 2021 in the second quarter of this year. So really impressive. Financials are really strong. We're starting to see some margin improvements and gaining some leverage and efficiencies as we're scaling. It's just really exciting time to be in the company, and the brand's doing extremely well. Celsius is performing really well in a variety of different channels, and a phenomenal quarter, hands down, to the team.
So how much of this is due to your partnership with Pepsi? How helpful has that been?
Yeah, we started shipping our first case with Pepsi back in October 1st. So we've been gaining more distribution, really over the last 6 months. We're at about 95% of reported stores. So we have a really good distribution. We have about 14 items in the average store, some more than others. And we did really well on this year's resets, which with major retailers, it historically has been late in the first quarter. So really excited to see, in Q2, Q2 was like a full quarter of the new distribution gained. We're gaining more cold availability each and every day, getting cooler placements. And right now, we're the #3 energy drink brand within the overall category. So we're really excited. We think there's a ton of opportunity and a runway ahead. And we're really just getting started with our partner, Pepsi, which, like I said, almost shipped their first case in October. So we're not really even a full year in of distribution.
So Pepsi, one of your partners, but you have had an endorsement deal with, well-known people like Jake Paul, for example. That literally came up on your conference call as well today. Give us a sense on how partnerships like that can boost your sales, especially when you have big events taking place involving people like Jake Paul.
Yeah, Jake Paul's been a great partner and a believer over the years as well. He's a tremendous athlete, did great, amazing 10 rounds with Nate Diaz over the weekend. That was great exposure for us. But we also are partnered with Inter Miami, which was a great partnership. And they just announced Messi joining the team as well. So that's really exciting for us. And then we also have the PFL, which is the Professional Fighting League, as well as NASCAR partnerships, a variety of other partnerships within a variety of sports and health and wellness industries. So, being a 95% ACV means our availability is pretty much everywhere in the country. And prior to Pepsi, we were pretty much regionalized. So now some of these bigger partnerships, we really got to do it to build the brand, continue to drive that momentum. And with the quarter delivering over $300 million in revenue, 112%, what we're doing is working. So we're going to continue to do that with these great partnerships and continue to gain credibility. But it really has to do with the product. The product's got over 7 essential vitamins. We got some great flavors. So we're hitting on all trends. The health and wellness trend is not slowing down.
My producer just pointed out that Monster Beverage is the best performer on the S&P since 2000. So over 23 years, it just shows that these sports drinks can do incredibly well. You mentioned partnerships that are primarily in the U.S., NASCAR and others. Are you looking to partner up with MotoGP or other more internationally focused sports to get your beverage out where, Red Bull and others are?
We have. We just started a partnership this year, kicked it off in Miami with F1, with Ferrari. So we're partnering with Ferrari in Austin and in Vegas this year. So those are now, global platforms. We're looking into those as we continue to scale with opportunities. Health and wellness trends are not just in the United States, as we know. These are global trends that Celsius is delivering on. And we were born in the gym and the health clubs. It's in our DNA. So we're looking for bigger properties to continue to leverage, especially as we gain more opportunities internationally. Right now, our biggest market currently is Sweden. We have approximately a 10 share in Sweden. We have some distribution in Finland, also have some distribution in some Asia markets as well.
So I'm just putting the numbers together here. You talked about the revenue that you've been generating. Wall Street now adding that up and looking at full year numbers that would take your top line beyond $1 billion. Matt was talking about Monster, which is give or take more in the $7 billion annual revenue level, but obviously a company that's been around a lot longer. What do you think the growth or the plan is from here? I mean, you've got this partnership with Pepsi. Could you see Pepsi taking full ownership? Wall Street's taking more notice of your business, or would you want to sell this business at some point? What's the plan?
Well, I think there's tons of opportunity. I mean, we're publicly traded, so we're for sale every day of the week, I guess. But in general, we're going on the long haul here. We see big opportunities. When you see where Celsius, I think when you look at Celsius and the runway ahead, we're seeing usage occasions with Celsius outside of traditional energy. And what do I mean by that? What he said on the earnings call, 11% of our sales to Pepsi right now is in the food service, non-reported channels, which is quite interesting and historically has been at a higher level than other energy drink brands they've had in their category or in their portfolio. So we think there's a huge opportunity, go after food service, those are the likes. Also, college universities is a big opportunity, and that wasn't even really included in the quarter because they were down for summer, right? Closed for summer. We got a lot of students coming back. We're going to be big in college and universities. We just graduated 170 students in our Celsius U University program. We had them down here in South Florida. It was great. We give them an education. They're employees of the company. They're going to be going back to over 17 universities plus around the country to activate. So really excited about that. Gaining distribution each and every day in those alternative channels. Doing well in club. And on Amazon, we're solid #2 on Amazon. We're doing really well and big on the omni-channel. Consumers want it when they want it, how they want it, and we're all about that.
If I look across the product Spectrum, you've got Celsius, also with stevia, Celsius on the go, heat on the go. Are you looking at any other product categories that maybe we wouldn't think of? Do you have anything in your back pocket there?
Yeah, no, I think, we're always looking at opportunities, but right now it's timing and sequencing. We have so much momentum, so much opportunity with our core portfolio right now. We have our core line, which is really fruit forward. We got some great flavors that just came out with the green apple cherry that's at 7-Eleven. We're expanding our Vibe line, which is really fun and inviting. We have a Cosmic Vibe right now that's just launching at Circle K. Really great flavors, a lemon lime that's the most refreshing energy drink on the market. So we're just really excited about the opportunity that lies ahead, gaining a cold placements, additional availability, and really partnering even further with our Pepsi partner.
All right, I mentioned your partner, Jake Paul. His brother, Logan Paul, recently there were some headlines around a drink partnership that he's got and the concerns around things like caffeine levels, for example, in products, and, the fact that there's a targeting of younger consumers as well. Do you have any concerns as you're growing so quickly that some people might be consuming these products and not fully aware of what's in the can?
Yeah, no, I think we really stand behind that. We're all about fitness and health and wellness, and it's 18 and up. That's who we market to. We market in the gyms and health clubs. A lot of our targeted marketing is all around 18 and up at festivals and a variety of programs. So we don't target kids or children under 18, and that's been in our DNA. Actually, what separates us from a lot of the competition is our demographic has been about 50-50 male-female and 18 to 45 plus in the category. So we're bringing new consumers and also older demographic of consumers into the category for the first time, which is really attractive to retailers and why we're gaining more additional space and availability as well. So it's quite interesting, some of the demographics around Celsius.
Well, we're seeing the stock reaction today to your latest quarter. John, thanks for your time. John Fieldly, CEO of Celsius, joining us today as part of our Stock of the Hour. Coming up, Apple gets a big win in its fight with Epic Games over App Store policies. We'll dive into that story. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Time for today's For What It's Worth. Our number, $1.1 trillion, as in dollars. That's the amount of developer sales Apple's App Store generated last year. Of course, not all developers are happy with the fees that Apple gets, and that dispute has been at the center of a long legal battle between Apple and Fortnite maker Epic. And today, the Supreme Court ruled Apple can keep its payment rules in place for the time being, rejecting Epic's attempt to force a change, Matt, to the App Store payment practices.
Yeah, I've been interested in this case for a long time, and it has been ongoing. Bloomberg Intelligence senior analyst Jennifer Rhee has the best overview of the story for us. And Jennifer, amazing that this has gone all the way to the Supreme Court, right? I guess the question is, what is Apple allowed to do with its own store, on its own operating system that it only sells on its own phones?
I mean, at least for now, Apple can just keep doing what Apple's doing, and Apple can keep charging the fees to developers that it chooses to charge. This is really, as you said, it's a long-running battle. The original court decision was back in September of 2021, and now it's wended its way through the appellate court up to the Supreme Court. And all that's really happened here is that the Ninth Circuit stayed an injunction that said Apple had to get rid of its anti-steering rules. In other words, Apple has to allow developers to communicate with buyers of apps or in-app purchasers and let them know they can buy them somewhere else outside of Apple's App Store. Apple asked for that to be stayed pending Supreme Court review. It was stayed. Epic is trying to get that unstayed, and they were unsuccessful. But this is temporary. It's going to be till about the end of this year, or it's going to be maybe about another year. We're just waiting to see what the Supreme Court does with the case and whether it takes it up.
So what do you think the next steps from here then would be in between that period, Jennifer, real quickly?
So the next step will be Apple will seek cert probably by the end of September, and then there will be a briefing process, and then the court will probably decide whether they'll take the case by November or December. If they pick up the case, then it's more briefing, oral arguments, and a decision likely probably in around June of 2024.
All right, Jennifer, thanks so much for joining us. Jennifer Rhee talking to us about this Supreme Court decision on Apple versus Epic. It's a story that seems to keep on coming. Right now, we're looking at markets that are falling, but we're well off the session lows with the S&P right now down less than 0.3%. The NASDAQ falling about 2/3. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From 20 countries. The moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Leaders become laggards and the laggards become leaders. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, rather.
Are you sure?
I had to think about it,
All
but
right.
I am Katie Greifeld. We're 2 hours away from the closing bell.
I'll let you be for right now.
Let's take a look at the market right now, because the S&P 500 is off by about 0.3%. Big tech doing even worse, currently off by about 0.6%. But it's really the bond market, which is interesting. Even though just looking at it, it looks like nothing's happened. You look at the 10-year Treasury yield, off by about 2 basis points, really clinging to that 4% level. We had that auction at 1 p.m. It went okay. We're going to get to it in just a bit. Let's talk about crude, though, because earlier it looked like maybe it was going to hit $85 a barrel. Of course, there's a lot of concern over Russian supply right now. We're off that level right now, but still up about 1%, Romaine.
Yeah, in fact, energy stocks actually one of the few bright spots in the market today. I was taking a look at the performance of energy really over the past few months, and we know it has been relatively down, but when you go back, of course, back to 2020, back to 2021, it has been the outperformer, and we're seeing that here today. It is the best performer in the S&P 500, outperforming the second best performer by 5-1. The folks over at Strategic is seeing signs of a new uptrend here as those months of outflows from the sector now turning into inflows. Investors being lured back by those valuations relative to the stretch valuations of big tech names, a potential comeuppance for big tech, and maybe a ratification for those energy bulls who've been arguing for months now that energy is the cheapest corner of the S&P while still offering high cash flows. And while energy stocks outperformed here on this Wednesday afternoon, Disney underperforming. The stock holding at break even on a year-to-date basis, but is actually down 13% since its last earnings report back in May and down about 5% since November 20th, 2022. That was when Bob Iger's return was announced. Disney set to report fiscal third quarter results after the bell tonight. We're going to have full coverage of those numbers as well as the commentary, but we know what investors are looking for. More detail on when the streaming business reaches profitability and just how the company will restructure those broadcast and cable TV operations. But Katie Greifeld, since you're here, let's start with bonds and credit here because they've been in focus. A big 10-year auction just a little while ago. It went okay.
It went okay. We got those numbers at 1 p.m. We were breaking down some of the bidding metrics right here. Let me explain this chart a little bit. Overall, it was pretty okay. You're taking a look at bid to cover right here. You can see that that was well above the average, coming in at about 2.56. That indicates stronger demand. Then you take a look at what percent that the dealers took down. Of course, obligated to bid, taking in less than 10%. Again, another sign of good demand. We had seen a lot of agita over who was going to buy all these bonds, but as Liz McCormick told us a couple days ago, Janet Yellen always gets her papers sold. But let's go from the Treasury market to the corporate credit market, because at August, we've actually got some pretty interesting moves right now. You can see a real trend has developed here where it's the riskier parts of the market that are outperforming right now. You see in purple, leveraged loans are leading the pack here. And then you can see triple C's in blue also doing very well this year. You take a look at IG, that's in pink there. It's actually down on a total return basis so far in 2023, Romaine.
Yeah, definitely a little bit of a perk up, though, over the last few days. Joining us right now to help kick us off to the close is Sonali Pierce. She's portfolio manager for high yield and multi-sector credit over at PIMCO. Joining us in studio here in New York. Great to see you, Sonali.
Thanks for having me.
Let's actually start off with, we did start to see a little bit of, I guess, attention, if you will. I don't know if it was appetite for junk bonds and even for some other, I guess, slightly riskier investment grade debt over the last few days, even the last few weeks. And some of that seemed to be tied to this idea of that soft landing or a more Goldilocks type of scenario.
Yeah, certainly. We have seen riskier parts of the market do quite well so far this year. That said, I would say that there is some tail risk there, whether it's a potential for recession probabilities picking up or in areas where we see low multiple businesses, low margins, which are difficult to pass through then the inflationary effects we're seeing onto the consumer.
Is the concern right now strictly about economic conditions? Is it still maybe focused on the Fed, or is there some sort of amalgamation of things that investors are looking at?
Yeah, we think the bulk of the Fed move is now behind us. We may have another 25 bip rate hike in September, but the bulk of the move is behind us. And so now we're looking at, at these valuations, the absolute yield is producing a fair amount of income. And that's what's been attractive to investors, despite the fact that the spreads levels themselves are less inspiring at today's levels.
Less inspiring at today's levels. I think that's a really important point, that even though maybe you might not see a lot of compression from here, you mentioned the total return. Is that the part of the cycle that we're in now, where basically you're just clipping coupons?
Yeah, that's exactly it, right? That with the starting valuations, we can afford to have a little bit of spread widening and still see positive returns. In fact, given where equities are today and where fixed income is today, there's an opportunity for investors to de-risk given the potential for call it a recession, but one that's maybe shallow and lingering, rotating into bonds where you can get long-term equity-like returns in the bond market today, which is quite different.
And I want to wrap in the Fed to this conversation because I think it's pretty well agreed at this point that the Fed is close to done on the rate hiking cycle. But if we see higher for longer yields, if those really do materialize, how does that filter through the high yield universe? There was an interesting note from Torsten Slok at Apollo earlier this week talking about the pernicious effects. It sounded pretty scary, but how are you viewing that overall?
Absolutely. So higher rates means it becomes more difficult for companies to meet their rising interest expense. We are seeing some companies have a lot of discipline today and are in the secondary market actually repurchasing some bonds at a discount to help reduce the total debt stock so that when they come to refinance at higher interest rates, it's a little bit less expensive all in. That said, especially in the floating rate markets like bank loans, private credit, rising interest expense, especially for the lower quality cohort, is certainly a concern.
I am curious as to whether we've made too much about the competition between different asset classes over this more recent cycle. The idea that, of course, everyone was in cash and short duration fixed income, and they said, okay, it's better to be there on a risk-adjusted basis versus equities. Now you're starting to see a rotation into other parts of fixed income. Is that competition there, or is it just more, I guess, an increase in allocations, increase in the size of those allocations, I should say?
Yeah, certainly. As we mentioned, the potential for the long-term returns that you would get in the stock market now that you can get in the bond market, but in terms of cash versus being invested, I think the idea is to lock in those higher level of yields and get out of cash, but be invested in the bond market. In terms of which asset class, I would say that often a multi-sector mandate allows for the flexibility and the liquidity to be managed by the portfolio manager to be able to take advantage of tactical opportunities as they come, whether it's an overshoot due to ratings dislocation or liquidity crunches.
Are there any sectors, though, right now that you would stay away from?
That we have some concerns in areas like retail, automotive, where wireline businesses, where some of this has had pressure from a secular basis, and some of it's coming to a head today, and some of it will be over time. But those are a few sectors that we're particularly cautious on.
And just to go back to what we were talking about, sort of at the beginning of this conversation, the fact that you do have high yield outperforming. If you take a look at the fund flows, specifically ETF flows, that's what I watch as a proxy here, it feels like this has been a very underloved rally, that you just haven't seen the appetite maybe from more tourist investors to come into the high yield space. Do you see that dynamic changing in the future?
I think for that to change, we would need to be pretty certain about a soft landing, right? I think at this stage, with the amount of uncertainty out there, somewhat of an up in quality bias does make sense. And to dip further down, you would want to do so with covenants, with some protection, really kind of underwriting the company itself that it has potential for spread tightening due to a catalyst.
Sonali, great conversation. Great to see you here in New York. Sonali Pierre helping to kick us off to the close, portfolio manager for high yield and multi-sector credit over at PIMCO. Coming up, a discussion about inflation, the big CPI report. We know inflation is slowing, but Americans, some out there say it doesn't actually feel like anything is getting cheaper. A look at the vibes. Katie Greifeld in just a second.
Meanwhile, in China, the story is disinflation as both consumer and producer prices fell together for the first time since 2020. We'll take a look at what it means for the future of the world's second largest economy.
And chip stocks on the back foot. The Biden administration expected to announce new restrictions on high-tech investments in China. We're going to talk about what those rules could mean, not only for those companies, but for you, the investor. All that and more coming up in just a bit. Stick with us. This is Bloomberg.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, we've heard a lot of reports recently about how inflation is cooling, but many in the U.S. aren't feeling it when they go shopping, and that's because most things are not yet getting cheaper. Bloomberg's Molly Smith has been reporting on this trend, and she joins us now. And Molly, I really like the framing of this story that you wrote, because you make the point that, yes, things aren't getting, you know, you're not seeing the prices increase as quickly, but the prices are still increasing.
Yeah, and I think that's what often gets lost in this discussion of inflation and thinking about how, you know, real people's lived experience of inflation is that you don't really take a lot of comfort in hearing that prices are rising 3% instead of 9%. The fact is they're still rising. The fact is they've still been going up for the past year or so, and they're not getting any cheaper. So you think about, okay, this hamburger used to cost me $18, now it costs me $25, and maybe it used to go up $5 a month, and now it's going up $2 a month. But that's not really a whole lot of comfort when you still hear that it's higher.
Well, you're looking at some of the prices there. Ham, chocolate chip cookies, a fan favorite there. Boneless beef stew, not quite a fan favorite. That's up as well. And American cheese, which I'm told actually isn't really cheese. But when we get to this idea here that these prices, not only are they still going up, but the general consensus is that whenever you have these types of inflationary spikes, those prices never really come down, or at least not materially.
Well, the thing is that you won't see them come down until there's outright deflation, as in inflation being negative, which you know, is happening in China, which is, you know, maybe that's good for China in some ways, but it's not happening here. So that's the problem when you think about, like, you know, it's tough to really convince somebody, you know, your average American right now, that like things are getting materially better for them because they're only experiencing disinflation right now, as in a slower pace of price growth.
And talk about how that ties into some of the sentiment measures that we've been getting. Because if you look at some of these survey-based measures, I mean, sentiment still doesn't look too good.
Right, so it did obviously come down in the University of Michigan measure. That's one of the more commonly cited ones. That hit a record low when inflation peaked last June. So it's recovered a bit since then, but you really have to think about this in terms of how do wages compare with inflation, and they only recently started growing at a faster rate than inflation, maybe the past couple of months, but that doesn't really make up for the fact that Americans have otherwise in aggregate experienced 2 effective years of pay cuts and less purchasing power.
The other thing, though, about these inflation reports, because it's funny you bring up disinflation. I mean, we've seen material disinflation in certain pockets there, but we kind of know that the average consumer, they tend to view inflation through the lens of the grocery store and usually gas prices for that matter. Maybe housing gets thrown in there as well. Is there any sense here that there is a case to be made that maybe things are better for them, even though they may not necessarily be seeing it on the price tags in those areas?
I think it would be tough to convince somebody that that's the case. I mean, depending on what kind of wage increase they've experienced, maybe so. Maybe that helps soften the blow. The pandemic savings that a lot of people have built up, that's also been helpful. But when you look at those main categories that you just said, food, gas, and rent, those have been where a lot of the big increases have come from. And granted, like some of it has come down, but gasoline is going back up again. Food prices as well, given what's going on with the war in Ukraine. And rents are, maybe stabilizing, but you still see home prices going up rapidly. And the more that happens, people are going to start to look at the rental market again. And that's probably going to be, that could be an inflationary pressure there.
Yeah, and of course, some concerns that we could see a reacceleration in inflation, particularly when we get that next CPI report tomorrow morning, 8:30 a.m. Washington time. Molly Smith, our economy editor here at Bloomberg, will be covering all of that, and we will have full coverage on Bloomberg Surveillance when that report hits tomorrow morning. Coming up here on the program, the Biden administration expected to announce new restrictions on high-tech investments in China. What does it mean for you? Emily Weinstein, research fellow at Georgetown University's Center for Security and Emerging Technology. She'll be here next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
China's consumer and producer prices fell together for the first time since 2020, and it comes as a major debt crisis may be brewing in the world's second largest economy. Joining us now for more is Bloomberg's international economics and policy correspondent, Michael McKee. And Mike, putting aside the potential debt crisis at this point, what do the inflation numbers tell us about China's economy?
Well, the biggest message is that China is not growing as people thought it would coming out of their COVID lockdowns, especially on the consumer side. Consumers are not showing so much demand. The goods are becoming scarce and prices are going up. This is the first time, as you mentioned, in quite some time that CPI has fallen and is actually negative. I'm not going to call it deflation yet because it's only been 1 month, and most people think it will go back above zero, but it certainly doesn't give you a very good picture of the Chinese economy. PPI is the same way. In China, PPI is seen as sort of a proxy for business spending and for production. And if PPI is as negative as it is, which is basically down 4.4% on a year-over-year basis, that tells you that production is pretty slow.
I mean, obviously we pay attention to this stuff. It is the second largest economy, and there have to be some ripple effects into neighboring economies, or at least economies that do business with China.
Well, normally there would be, but we're in this unusual situation where we are buying less from China, and so is the rest of the world because of this reshoring and the idea that you don't want to put everything into one supply chain. You take a look at what export prices are from China, and then you look at what we're buying in terms of the overall imports, and we're not buying as much, and we're buying it at cheaper prices. So it's not going to have the kind of effect that we thought it would have. It would have a little bit of a deflationary effect if we were buying more stuff, but it isn't going to be a major contributor to probably any country's inflation situation.
All right, Michael McKee there, our international economics and policy correspondent. A look at the state of the Chinese economy, an economy that could actually be affected by some new rules coming out of the Biden administration here in the U.S., expected to announce a plan that would restrict U.S. investment in Chinese companies involved in cutting-edge sectors like quantum computing and artificial intelligence. Emily Weinstein joining us right now, research fellow at Georgetown University's Center for Security and Emerging Technology. And Emily, just set the scene for us here, because there's been a lot of focus on this, and we haven't gotten the official proposal just yet here. But there is some concern that if you cut off the flow of money, foreign money, into China with regards to these particular technologies, that could potentially, I guess, squash their innovation. Maybe that's the goal of the Biden administration, but do the numbers really add up to that? I thought most of their investments in these types of technologies were homegrown.
So it's a great question, and I think previously I did some work with some colleagues to try and actually dig into the numbers, in particular as it relates to U.S. outbound investment into Chinese AI companies, AI being one of the sectors that is allegedly going to be covered in the executive order that we're, I think, going to see later today or tomorrow. When we looked at U.S. investment into Chinese AI companies from the period of 2015 through 2021, what we actually saw was that Chinese domestic investors were the #1 investors in their own AI companies, which I don't think is very surprising. But when we look at the #2 spot, that's where U.S. investors sit. And U.S. investors during that time period invested in, or participated, in about 17% of those investment transactions. So still could have an effect, but again, China is the majority, and Chinese money is really what is powering these AI companies.
Well, this is kind of, I think, getting to this idea here. I mean, I know that it looks good politically, and maybe there is some effect here, but not only are we talking about a lot of money that's already coming from non-U.S. sources, either from within China, but based on Bloomberg reporting, at least, there appear to be a lot of sort of asterisk, if you will, certain companies that can invest in conglomerates, just not dedicated AI firms, a 1 year or so period where these rules would take to go into effect, and it's not going to be retroactive. So I guess if you want to do this, get in the door now over the next 12 months.
Yeah, I think it's a really valid point, and it's hard to say exactly how the administration is attempting to kind of proactively deal with some of these potential workarounds. When we did our study last year, we did see that there are a number of potential workarounds. There are ways for folks to set up shell companies, that you can go through these types of conglomerates. And because we've heard that the executive order, or at least parts of the executive order, are not going to take effect immediately, it does maybe open up an opportunity for folks who want to get in that door last minute to do that. But I do think that the Biden administration is going to be very clear about what exactly is being prohibited. I think when it comes to what is going to maybe require some type of notification, so meaning that companies, if you want to invest in a Chinese company in one of these sectors, you just have to notify the U.S. government before doing so. I think that's where things will be a bit more fuzzy, and it will be interesting to see how the administration decides to tell us how they want companies to abide by that.
And Emily, to your point that maybe some investors might be able to get into that door to invest in some of these Chinese companies before that door closes, what's the typical makeup of the U.S. investor coming into some of these Chinese companies?
Yeah, so when we looked at the top U.S. investors that were investing in Chinese AI companies, the majority of them were your kind of traditional Silicon Valley type venture capital companies, with GGV Capital being the top U.S. investor. But we did also see examples of corporate venture capital firms, particularly those that are very active in the AI ecosystem. So things like Qualcomm Ventures. We had Intel Capital Corp a few times, same with Microsoft. So there is definitely a kind of wide berth of the types of companies that are investing in these Chinese AI companies. But notably, one of the really interesting patterns that we did see was that the majority of U.S. investment that was going into Chinese AI companies was coming at that super early venture stage or venture capital stage. So I'm talking angel, pre-seed, maybe even Series A. So it goes to show that there's something interesting that comes with maybe the mentorship or coaching that is such a part of that early stage investment, early stage venture capital investment, that maybe is the choke point in what Chinese companies are looking for from U.S. investors.
And just to, again, couch this in the political conversation, if the goal here is to sort of temper China's AI progress, maybe slow that down, and you think about the profile of these U.S. investors coming in, the fact that there's really not that many of them relative to domestic investors, what likely impact would this have?
I think the impact, at least at the outset, will be relatively limited. But I think what we will see is this having a chilling effect overall on both investors in the United States, and I would say investors in allied countries, perhaps, in their attempts to invest in some of these high-tech sectors in China. I think this type of executive order will send a message that, hey, this administration believes that there is a risk to investing in these sectors in China, and so this may obviously proliferate beyond what the actual executive order specifically lays out.
All right, Emily, great stuff. Emily Weinstein there over at Georgetown University Center for Security and Emerging Technology. We should point out that Bloomberg is reporting that those rules will come down pretty soon here. Still awaiting to get that official word. Meanwhile, we turn back to the market. The market started out on the back foot, but believe it or not, starting to show some signs of life with about an hour and a half until we get to the closing bells. While big tech stocks are down on the day, the Dow Jones Industrial Average now starting to poke itself into the green. Most of the other indices right now well off the lows of the day as we head towards those closing bells. Stick with us. Romaine Bostic and Katie Greifeld. This is Bloomberg.
Connection lost.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg Markets to Close, a busy day in equity markets, a busy day in the bond market, and a busy day in commodities. Abigail Doolittle standing by right now with our commodities close. Abigail.
And we're looking at gains for commodities, Romaine, some bigger than others. But let's start off with New York crude, which has sort of been all over the map. Not so long ago, it was up just slightly, now up 1.7%. Continued supply concerns boosting it higher. Natural gas up 6.5%. There are some supply concerns there, too. But take a look at European natural gas futures. Unbelievable, up 28%. And this, of course, as LNG supply risks mount, really driving European natural gas higher, helping natural gas here in the U.S., a sympathy trade. And then rough rice I have not looked at in probably more than a decade. It's up 1.1%. And some of this has to do with Thai rice. If we switch up the boards and go into the Bloomberg terminal, we are going to see that Thai rice has surged to its highest level since 2008. And this basically another supply concern story. Weather in Thailand very dry, suggesting that there might not be as much rice to take out from the crops as expected. And so the price of Thai rice going higher, also pushing rough rice higher. But let's take another look at the European natural gas, because it too is spiking higher. And if we had moved this chart back a little bit, it wouldn't be so much green. But over this very brief period of time, basically 1 month, we now have European natural gas up about 50%. And again, today's spike, Romaine, really has to do with the LNG supply risks continuing to grow and traders reacting in a very bullish way for natural gas, European natural gas.
All right, Abigail Doolittle there, a look here at the commodity space. And let's stay in that space because a lot of this, of course, has to do with weather conditions. July officially the hottest month on record for Earth. Last month's extreme weather patterns included heat waves across much of the Northern Hemisphere, Europe, North America, and Asia. Just yesterday, the President of the United States signed a bill aimed at tackling climate risk on the economy. Take a listen.
I signed the largest climate bill in the history not only of the United States, but literally in the history of the world. It'll save working families thousands of dollars a year if they install rooftop solar or weatherize their homes. It also creates enormous employment, enormous growth, and things that better people's lives.
And that was the President of the United States. Abnormal weather also putting a major dent in the earnings of U.S. utilities. Kelly Laparo joining us right now. She covers power and renewables for Bloomberg News. And I was just taking a look. Utilities as a sector, worst performer in the S&P this year. And a lot of that has to do with some of the earnings that we've already gotten out of Duke, out of Southern Company. A lot of this seems to be tied to that extreme weather.
That's right, yes. So if you remember, we had a pretty warm winter, and the spring was also very mild, particularly in the Midwest and along the East Coast. And so that led to lower demand for people to cool and heat their homes, which translates to lower revenue for these utility companies.
And so that's what happened in the winter. And I don't think it snowed once in New York, but bring us up to speed on what's happening now, because now we've seen really extreme heat. What does that mean for these companies?
Right, so people are, this is a big question mark actually. There has been a lot of extreme heat, which does typically mean that there's going to be higher demand for air conditioning, so higher demand for electricity. And people are wondering whether that's going to help the utility companies sort of balance out throughout the second half of the year after a pretty tough performance in the first half. But we don't really know, because actually the first half ended up being pretty much worse than expected, so they have kind of a lot to make up for there.
Well, how did these companies prepare for this, right? I mean, this has kind of been that slow-moving storm, right? I mean, climate change didn't just creep up on us over the last 2 months. I mean, this is something we've been talking about since probably before I was born. Remember Earth Day, when they started that dating? That was before all of our times. But in all seriousness, I mean, these are businesses, and they don't obviously deal in the politics of it all, and we know this is kind of a political football. They have to deal with their bottom lines, and right now we know it's affecting their bottom line. So what are they doing to address this longer term?
Right. Well, there are a few different things, and you know, the sort of lower expectations this year, or sort of the beyond low expectations this year, had to do with actually there was a pretty good performance last year, so there was sort of a bigger distance there than people had expected. But right, weather will probably still continue to be volatile and have unexpected consequences. So there are a few different levers. Mostly utilities are having to work with regulators to figure out how to smooth out these unexpected weather patterns.
Yeah, and charge us more, right?
Right.
No.
These are seasonal businesses to an extreme. Kelly, really appreciate your time.
You should have seen my Con Ed bill. I paid it the other night.
Really?
It was like double what it was the previous month.
Hate to see it.
Yeah, I hate to see it. So
makes Kelly's life busy. Kelly LaPara, thank you so much. Thank you. Still ahead, Wynn Resorts reporting second quarter results after the bell. We'll speak with David Katz at Jefferies about the trends he's seeing among casino stocks, with demand in China being a big focus for investors. That's next. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
All right, time now for our top calls. The big movers on the back of analyst recommendations, easy for you to say. Let's start with the advertising tech company PubMatic. Macquarie downgrading to neutral and slashing the price target to 16 from 23. The analyst warning of a significant downturn across all forms of advertising next quarter, which calls in a lot of questions here about the company's revenue. PubMatic shares having an awful day, down 31%, worst day since they went public. Next up, let's take a look at Datadog, getting cut to hold over at Stifel. This after the software company cut its full-year revenue forecast. Now, keep in mind, the report out of Datadog showed a decline in quarter-over-quarter usage growth, despite the fact that a lot of its hyperscaler peers actually showed better growth. That's causing a lot of concerns for the analysts, hence the downgrade. Shares down 1% on the day. And finally, let's take a look at Penn Entertainment. Jefferies analyst David Katz maintaining a hold rating on the shares. This after the company announced an exclusive online sports betting partnership with ESPN. Katz says Penn has the potential to reposition its business to gain share over time, but he does expect the shares to be volatile in the near term. Having a good day, though. Actually, one of the best days they've had in about a year, up about 12%. And those are our top calls. We do want to stay with Penn National right now because that partnership with ESPN is spurring a lot of questions and concerns here about competition in the sports betting arena, particularly for companies like DraftKings and casinos like Wynn Resorts, Wynn actually scheduled to report earnings after the bell tonight. Pleased to say that David Katz joining us right now over at Jefferies to talk a little bit more about this space, a relatively crowded space, David, that we know has very high acquisition costs. And I am curious that when you look at it through the lens of Penn sort of hitching its wagon to Disney and ESPN, is that going to leave DraftKings and some of these other players out in the cold?
Not necessarily. The way we've looked at this from the beginning, sports betting, is you need market entry, you need brands or eyeballs, content and technology. And, clearly we can see where, the customers and the brand that's brought to Penn, who has considerable amount of market entry. Penn has acquired the Score Media for $2 billion and has a technology platform that is being rolled out now, which is expected to work. But what we're finding these days is that product has been winning. FanDuel and DraftKings have increased their market share leads because their product advancements, whether that's the kinds of bets within their app or the ease of use and the wallet functionalities are better. And so, that's one of the questions that comes up for us today, with Penn, and it is an exciting deal, and it does bring them quite a bit of scale in terms of customers. But, how will the technology and the content evolve for them to execute on these opportunities?
Well, that's what I am curious about, because we've talked, at least on this program, a lot about the acquisition costs to get customers onto these platforms, which can be high. But we haven't talked so much about the stickiness, if that stickiness is there at all. Is there brand loyalty out there when it comes to these, particularly with the online gaming casinos?
I think that's been proven to be true, that there is, in fact, a stickiness to customers. And I think the evidence of that, the best evidence of that, is that we've seen over the past 2 quarters the promotional giveaways being ramped down considerably, which has driven some of the profit reports that we've seen, and yet the revenues and the usage has still remained very high. And so I think that makes the case that the stickiness does work, and that a promotional dollar spent wisely is well spent.
And David, you brought up the value of brands here, so let's talk a little bit about that, because with this deal, Penn gets exclusive rights to the ESPN Bet trademark. It's going to rebrand its Barstool Sportsbook to ESPN Bet. Is that a better brand than a DraftKings at this point? How are you thinking about that?
Well, I'll answer your question directly, which is that remains to be seen. I think when we look at the sports betting value of an individual who is on DraftKings, who's a sports fan, who spends money to play, right? They have clearly found the sports betting watchers who like to play. And I think Penn will have to go through ESPN and find the sports betting watchers who also want to bet and want to spend money. And so is it better? I think that remains to be seen. It certainly is quite a bit bigger. And certainly possibly could turn out to be better, but it will take some time. And the one point, Katie, that I do want to make very clear is what we've seen is timing of entry into this business is a critical success factor. And those that were ready on day one when a state opened and enter have tended to do better in terms of capturing market share. And one of the questions that came up on Penn's call this morning is that you're entering a bit late with this brand. And are you going to be able to capture the share that you've laid out, given that you are entering late? And so, that's a part of the answer as to whether ESPN will turn out to be better, even entering late.
Yeah, that first mover advantage, huge there. So wrapping that together, you look at a 9% drop in DraftKings on a day like today from news such as this. Does that look overblown to you? Is this a buying opportunity?
That is precisely what we told our sales force this morning. That one of the reasons, we like DraftKings, we've continued to like it. It's been a great performer this year, and we think, quite frankly, the rest of the year is going to be very powerfully strong for them, particularly through football season, is that their product momentum has really picked up over the last couple of quarters. The mix of parlays that drives hold and margin, the ease of use, and what we understand is that there's quite a bit more to come in terms of that product offering that puts them ahead. So our call this morning, Katie, was absolutely this is a buying opportunity on DraftKings.
Do you anticipate, David, that we could see other deals, kind of like what we're seeing with Penn and ESPN?
Short answer, no. We are not expecting other deals like this one, but we are expecting deals. As you look down the roster of smaller players in sports betting in the U.S., the gap between the haves and have-nots has continued to widen. And what we saw earlier is an entity like Fanatics coming in and buying the U.S. enterprise of PointsBet. And the PointsBet folks were very clear that it was just too hard to achieve scale to get to profitability with it, and so they turned around and sold. We think that there's any number of entities across inside and outside our coverage across the industry that could consider being consolidated. More is in that value chain the way I describe it, right? With market entry, less about brands, more about content and technology.
All right, David, great to catch up with you. David Katz over at Jefferies. A look at Penn National and the rest of the gaming community. Penn shares up about 12% on the day. Win results coming after the bell tonight. After we come back from the break, a sit down with David Malpass, the former World Bank president, a discussion about the difficulties facing the South African economy. That's our Wall Street Week Daily segment. Up ahead, this is Bloomberg.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
DOJ or other authorities.
Could face bigger challenges. What's next?
It was going to keep Great World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right
A
direction.
record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back to Bloomberg Markets to Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. And David, a big focus right now on the global economy and one of, I guess, what was once one of the more important economies in the world, at least in Africa, and that was South Africa. But they've been having a lot of troubles as of late.
It's a very important economy there. And it's one of the BRICS, of course, which are going to meet actually in Johannesburg later on this month. And there had been a time that foreign direct investment was going in there. Right now, not so much. They're having a lot of problem with growth and also the capacity, frankly, of the federal government. So we turned to David Malpass. He's the former World Bank president, spent a lot of time down there. We asked him whether, in fact, the private sector could step in for the public sector in South Africa.
It's having severe difficulties both in terms of growth but also inflation. The currency's been weakening and public services are breaking down. So this is electricity and clean water that are so vital to people and there's a breakdown of the infrastructure. So there's a huge amount of work to be done.
We've seen some reporting, Bloomberg's done some reporting on the private sector having to step in because of those public services failing. Is the private sector able to make up the difference?
I don't think they can. You know, governments are needed in some of the basic infrastructure, the maintenance of transmission lines. In South Africa, they have an electricity company called Eskom, but it's been having difficulties really for 10 or 20 years. It's heavily unionized, very hard to get the maintenance done and the input, the actual production of electricity sufficient to keep the grid going. And that means that private companies then turn to diesel generators, so you lose your best customers and you're increasing the carbon intensity at the same time.
I know you've spent some time there. You visited, you understand the country. It is a dominant economy in sub-Saharan Africa. It is the only one that's part of the BRICS, so-called BRICS. It was admitted relatively recently. What's gone wrong?
As you look back, they became a free country in independence and had some infrastructure to work with, and then it needed to be maintained and increased. And that's the hard part for governments, to find a political system that really makes decisions on spending, for example, where they often were spending too much on things that weren't working. The flexibility of the labor force is critical. So South Africa needed to really focus on how to have skills for the labor force and then allow the labor force to move around within the private sector. And that got lost over the decades. And so it's a country with giant potential, but really needs fundamental changes at the government level. I don't think the private sector by itself can make up for it.
David, you know the country well. You've spent time there. Is there movement within the government right now to try to adopt some reforms, if I can call it that might address the concerns you have?
They're constantly working on it. President Ramaphosa has been in lots of international meetings looking for ways to pull the country forward. There's an election coming up, so these are some of the topics in the election. But a lot of it is getting the details right in terms of electricity production, electricity distribution and transmission, and also in terms of allowing the private sector to actually create jobs and grow. The tax system is still problematic, and the currency has been weakening. So you've got these core problems that need to be addressed from the top down, from the government side.
The United States, I know, is a major trading partner with South Africa, as is China. What's China's role right now in South Africa?
It's important because it's exporting a lot to the world and to Africa, and also building things, and so it provides loans. But one of the key things is to have them be more transparent so that people know what they're getting for the money. China is a big trader of small goods, and in a lot of Africa, that's really important for them to get the consumer goods that they need for everyday life. So China's an important factor, but I think could do better in terms of transparency and relationships. As we look at Africa, China shows that a country can come from poverty to rapid growth over a period of years. In 1993, China stabilized the currency and then allowed market pricing within the economy, and so they ended up with 10% growth per year. I think African countries could do that, but they would need to make major changes in the way the government interacts with the private sector.
Another country that has come into the news with respect to South Africa is Russia, because the United States has been concerned about what possible relationship there might be between South Africa and Russia. We saw actually in an interview recently with Bloomberg with the head of Nedbank, a big banking holding company in South Africa, concerned that in fact trading relations might be strained with the United States because of Russia. What is the issue? Is South Africa caught between the United States and Russia?
South Africa is playing countries against one another. I think that's a dangerous game. The U.S. needs to show strength and engagement with Africa. That's been lost. The Afghanistan evacuation was a sign and a turning point away was a sign and a turning point away as the U.S. moved away from the world. And so this is apparent, and Russia and China step into vacuums. We've seen that in Niger. I was there in March, and it's the security concerns in Africa are immense, and Russia and China are taking advantage of those. The BRIC Bank that you mentioned is Brazil, Russia, India, and China, and so they and South Africa, so BRICS, I guess we can call it, they are allowed to operate on the international scene equivalent to other international organizations, even though it's a narrow membership of those countries. And so I think there has to be a rethinking also of the international financing system to give less dominance to Russia and China.
That was David Malpass. He's a former World Bank president, of course. And normally when you have a country that's struggling economically, you look for foreign direct investment. Yeah. David says right now it's not an attractive enough proposition to really get the foreign direct investment that they need.
Yeah, and there's too much of a volatility going on right now with regards to just all the different sectors there. And I think people want to see some stability.
Yeah, and you worry about the economy, worry about the people.
Yeah.
I mean, the people are the ones who are suffering ultimately. Yeah. So tomorrow we're actually going to have Libby Cantrell, PIMCO Director of Public Policy, talking to us about the fiscal stimulus still to come that could bring us back a little inflation. And on Friday, we're going to talk to Deborah Lair. She's Edelman Global Advisory CEO. We're going to talk about China with those China numbers out today. And that'll come up at 6 p.m. Eastern Time on Friday, Romaine.
All right, some great discussions coming up on Wall Street Week. David Weston joins us every day around this time for Bloomberg Markets to Close as we round the final hour of trading here on this Wednesday afternoon. Similar price action that we saw yesterday here with a big downdraft at the open, coming off the lows as we get closer to the close. But of course, two big potential speed bumps up ahead. You have a CPI report tomorrow morning at 8:30 a.m. Washington time, and then that producer price index the next day here, whether that provides an upside catalyst or downside.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. It is Wednesday, August 9th, 2023. Carol Massar, along with Tim Stenivek, and I'm kind of calling this a pre-CPI day because I feel like we are thinking a lot about inflation today.
We are thinking a lot about inflation thanks to what's going on in the bond market. We're going to dive into that in just a few minutes. But Carol, as you always say, watch the bond market. You do.
I do. I mean, it's been another interesting day. We had another big Treasury auction, 10 years specifically, $38 billion worth. And we did see what was a bit of a sell-off on the equity side of things kind of come off its lows, and a very different trade here because of how the auction went, because we've got a lot of new supplies. Anyway, we're going to get into all of that in just a moment. With that all in mind, top of mind for us is Rustin peace recession?
Question mark. That's the question, right?
I mean, should we be worrying about inflation? There's a great opinion piece by Connor Sen that gets into some reasons maybe why we should be worried. We're going to also bring in our Michael McKee, who tracks all of this.
I'm gonna push Connor on this because I'm getting so much different data. Like, I thought all the companies are saying we're not buying couches, we're not buying appliances like we were a couple years ago. We're spending money on services.
Yeah, but he's writing that we're seeing some moves off of that, especially as people are buying houses. Gotta put stuff in houses.
What is this, 2020?
Kind of preaching to the choir. You know about.
I know.
All right, we'll get into that
You need to
later.
sell a house before you buy a house.
You do. All right, speaking of all of that, too, we're going to get to the place in the U.S. that has said bye-bye to inflation faster than the rest of the nation. It's a very unique, interesting story about one city in this country.
Plus, we got Disney earnings after the close today.
Wait, what?
I know, we spent a lot of time talking about Disney yesterday, but today's the big day.
It is the big day. Bob Iger's been doing some things, so we'll see what they have to say about the results. And, of course, that news yesterday about really moving much more into actual gambling and using the ESPN name to do that specifically. Hey, we're also going to get into a bunch of corporate stories. We mentioned Disney. We're also going to talk about Amazon and talks to join other tech companies as an anchor investor in ARM's IPO. So we're going to get into what that is about. And then WeWork's troubled future. It's like, wait, yeah, it's still got issues.
You thought WeWork is having a tough time. It's Carol. It's down 98% since the IPO.
I know, it's kind of like what's left here.
This was the darling in 2017 in the private markets.
It was the darling.
Yeah.
Not anymore. All right, and then we're also going to get into revenge traveling, talk about what's going on in terms of travel trends. First up, though, we are going to head over to our TV colleagues, and we're going to talk about the markets. Countdown to the close. It's starting right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenivek. Welcome to our audiences across all of our Bloomberg platforms, television, radio originals, and our partnership with those folks streaming on YouTube. A little bit of a repeat today, Carol, and at least in equity markets, to what we saw yesterday here, ahead of what's going to be a pretty consequential economic report tomorrow morning.
Yeah, absolutely. We're talking about the inflation report, CPI, tomorrow, and I wonder how energy will play into all of this. Of course, we always back it out and say it doesn't matter, food, energy, but it does matter today, certainly. And you talked about it earlier, Remain on television, about energy stocks are your outperformers in today's trade. If you look at the best performing major.
You do watch.
Occasionally. Well, Katie was on with you, so I kind of.
I mean, you guys are like right around the corner anyway from her desk. So you can hear what you're saying.
So I just have to yell and she'll miss.
You know, I kind of multitask. Listen a little bit. All right. So anyway, energy stocks, your top performer, major industry group in the S&P 500. You got oil hitting its high for the year, highest in nearly a year. Supply risk growing in the market. We talk about some of the right through today about an escalation of the conflict between Russia and the Ukraine, choking off supplies in an already tightening market. So we're seeing this certainly play out. We also had some weekly U.S. crude production numbers surging to the highest since March of 2020. Which maybe would go against that, but nonetheless, higher oil prices today, Tim.
That's me.
What's your name?
I'm Tim.
Wow, you two are close, I see.
She was gone for a week. You know, she forgot. She forgot who I am.
Tim,
That's okay.
Matt, Katie,
Look, remember, this is a
Jess.
supply story. It's not a demand story. I think that's important to keep in mind because there is still a demand story here. Especially we talked about it earlier in the week with the concerns out of China, and if China's economy is soft, which all signs are pointing to, yes, it is indeed soft. Demand concerns continue there when it comes to consumption of oil.
Yeah, certainly so. And we've seen that in the volumes, not necessarily in price, but in terms of the volumes of what's been bought, Katie.
Yeah, and I mean, I think that's really the interesting thing about the oil market, the flip-flop between whether it's driven by supply or demand. But let's talk about sports betting, because one of the big stories,
Is that the best you can do on a segue, kiddo?
Tried.
I know, it's a hard one. It's a super hard one. Sorry.
Okay,
I've tried to teach her.
Well, let me hard pivot into what I'm going to talk about here. We're talking about Penn, of course. Penn absolutely soaring today. It's up about 10%. It was up as much as 18%. It had been up 35% pre-market, and the reason why is because it's inked in U.S. online sports betting deal with Disney's ESPN. Of course, the Disney that reports after the close today. So to get into some of the specifics here, this gives Penn exclusive rights to the ESPN Bet trademark for an initial 10-year term. It's going to rebrand its online Barstool Sportsbook as ESPN Bet. You would imagine that's a pretty powerful brand. And of course, it's divested Barstool Sports back to its founder, Dave Portnoy. The sell side is psyched about this one. It's been really interesting reading through just the wave of research reports on the back of this.
Yeah, I mean, this actually broke yesterday after the bell, and I mean, it was, I mean, everybody just sort of stopped, right? Because there's been all this discussion here about not only what is going to happen with ESPN. I mean, I know everyone's looking at it through the lens of Penn National, but we know there's a big strategy shift going on at Disney, and you sort of wonder what this means for that brand, ESPN as a brand, and the way that it's now sort of locking in Penn National. And this is a 10-year deal, too, so this isn't just something they're just experimenting with.
We also spent a lot of time talking to Chris Palmieri about whether this is a cultural fit and what it says about the culture of Disney now that they actually are bringing in sports betting. I mean, we're talking about Mickey Mouse here. We're talking about Walt Disney World.
The House of Mouse.
Come on.
You think that ship sailed?
Mickey at the craps
when
table?
they bought FX, when they bought Fox's assets, or before that?
All I'm going to say is kudos to Bob Iger for changing the narrative right before earnings. And, you know, you think about he brought back Tom Staggs and Kevin Mayer, I'm not sure, forgive me. But they were brought in to kind of work with ESPN and figure out how to leverage it and make some partnerships. So kudos.
Okay, well, as Carol pats him on the back, I'll say he still's got a lot of unfinished business, incling profitability at the streaming service, a restructuring of that linear television business, and of course succession planning, because you know Iger, you know, he ain't gonna live forever.
On that note.
Sorry.
It is the magic
We got to
kingdom.
balance each other out here,
Debbie
Carol.
Downer over there.
That's why you're on
I know.
opposite sides
Seesaw
of the
balance. I got it. All right. Anyway, we will be back maybe in less than an hour's
Good
time.
to see Tim smiling.
He always smiles. All right, we are going to break down those Disney earnings. Join us, though, at 4 p.m. Wall Street time, Beyond the Bell, cross-platform, radio, TV, YouTube, and Bloomberg Originals. We'll see you then. All right, folks, we're going to stay with the inflation story because it's a big one, and it is certainly a focal point for the markets this week. A closely watched bond market gauge, by the way, of expected U.S. inflation rising back toward a 9-year high. It is signaling some concern that the Fed may continue to wrestle with elevated price pressures for years. This comes ahead of that CPI report tomorrow, which is a key long-term measure of where the market sees inflation heading, and it has risen to around 2.5%, just shy of the peak back in April of 2022, and it reached the highest, Tim, since 2014. So a lot going on, and we're thinking big time about the inflation picture here in the
We
US.
certainly are, and we got a great roundtable this afternoon. With us now for our U.S. inflation picture, what's to come in worries that are weighing on the trade today. We got Bloomberg News international economics and policy correspondent Michael McKee. He joins us on Zoom from New York City. And Bloomberg opinion columnist Connor Sen. He's on the phone from Atlanta. He asks in his column today, is it time to worry about inflation again? So he asked the question, so Connor asked the question, I'm going to pose that question to Mike McKee. Is it time, Mike, to worry about inflation again?
I don't think it's time to worry about inflation again, but I think we should be, and Fed officials are, aware of the points that Connor is making. If the economy doesn't go into recession and we do see continued strength in the economy, demand doesn't fall because unemployment stays low, then yes, you're going to have the possibility of inflation. The one weird thing is that nothing has behaved as it should in this recovery from the pandemic. And so while that's a normal narrative about inflation, we're not sure that that has any bearing on what's actually happening these days, because inflation has come down a lot, but unemployment stays really low and consumer spending isn't out of control.
Yeah, really good point. Come on, Connor, come on in on this. I don't think you and Mike are quite the Zuck-Elon cage fight yet. But talk to us about your column, and you just heard what Mike said. Reply to that, respond to that.
Sure. So the question that I have and the concern that I have is that goods spending is now picking up again. And that was something that really tailed off beginning in the spring of last year as consumers shifted their spending from goods to services. And we saw goods inflation, which was really the driver of inflation in 2021 and 2022, come off pretty hard over the past 12 or 18 months. We've seen energy prices until recently come off a lot. Used automobile prices are still falling. This sort of furniture is now down in price. And so the question that I have is, if goods spending picks back up again, will we see that kind of goods inflation spike back up?
Mike, is this something that the Fed has to be careful about? And maybe this is why they keep reminding us higher for longer, even if they stop raising rates in the near future. This whole idea of, we have seen, right, housing start to pick up again, and you know, we're watching some of these spending patterns. Is that why the Fed is going to have to be vigilant, if you will, in terms of keeping rates higher for longer?
Well, that's exactly why. They want to make sure that inflation, the inflation dragon is slayed, as they would say, because the fact is, we could see, if you started lowering rates too soon, the enthusiasm to buy things pick up again, especially if the economy remains with the kind of strength it has right now at 5.5% interest rate. If that goes down, then we should see some more enthusiasm, and that could set the stage for additional inflation. So the Fed wants to keep interest rates high for longer to make sure that they're getting close to 2%. And at that point, they can slow down. They'll start to lower rates, but not all the way. But they want to keep an eye on the overall economy's strength and what people's buying habits are.
Connor, let me just get this straight from you. Are you seeing any data that show that goods spending is picking up? Because what we're hearing, what I'm seeing, is that services spending continues to be what we're spending money on now that we have our couches and washing machines.
Well, it's interesting. So year to date, and this is from the monthly personal income and spending report that comes out at the end of the month, real spending on goods has grown faster than real spending on services. And so that the growth rate between the two has really converged after last year when services spending outpaced goods spending. And I think that's because goods prices have fallen, incomes continue to be strong, and workers now have, they took a year off from buying Lazy Boys and grills, and you can't hold the American consumer down for too long.
But does that mean that the companies that make these things, the Webbers, the Ethan Allens, they have a better idea of supply and demand, because what we saw during the pandemic is an anomaly, so we won't necessarily see those prices rise again?
It's possible. And so right now, the market's just been encouraged that sort of orders have stabilized and inventories are now in a good place, and their costs have come down as freight and energy costs fell, so their margins have been better. And it could be that we have a lot of spare capacity before we have to worry about prices rising again. Although I guess you look at something like oil, which is up 20-25% in the past month and a half, and maybe these things can come back faster than we think.
Mike, what's your take here, or what you're seeing and observing, and what jumps out for you in terms of services versus goods spending?
Well, I think you have to look at oil, as Connor says, but also leave it to the side, because there's nothing anybody can do about that. Fed can't make a difference, nor can fiscal policy make a difference there. But in terms of goods spending, yes, it's been growing at a faster percentage rate than services, but services inflation has also been higher. And also we have seen on a dollar value basis, a lot more money going into services. It's less that I think goods fell terribly than it is that services have more than caught up, and people are now sort of balancing back out again.
Mike, when you think about inflation, can we get to that 2% if we continue to see a tight labor market and we continue to see, wage inflation?
Well, central bankers will tell you you can always get to whatever target they want, because they can raise interest rates until they get there. I think they can, but it's going to take longer than maybe people think, because we've picked the low-hanging fruit. That last percentage point from 3% down to 2% is going to be much harder to achieve because it's more embedded inflation. But the Fed's going to, they say, keep at it until they get there. At that point, it'll be interesting to see what they do because they've talked about raising the target to 3%, in which case we're already there. But I think they can get down to their target.
So, Connor, if indeed consumer spending on goods continues to accelerate, and we do see concerns about inflation there, what does that mean for what the Federal Reserve is going to do, in your opinion?
The hard part right now is that right now we have, and I think we're going to see this tomorrow, we have a fair amount of used car deflation that's going to flow through the CPI report over the next few months. And then shelter continues to come off. As Mike has said, services inflation is finally slowing. And that's something we should look forward to for at least several months. But it's sort of the other side of that would be at some point used car prices find a bottom. And if demand remains strong, then maybe those pick back up again. And maybe oil passes through, even though, to Mike's point, you can't control oil directly. But that does it's a transportation cost that can flow through the system. And so if we see inflation start to tick back up in the first half of 24, when the Fed has been sort of anticipating cutting rates next year, does that put people off sides again? And will we have sort of a mini 2022 in the first half of 2024?
All right, so coming off your column today, Connor, what are you looking out for tomorrow in the inflation report?
I want to see used cars because to me that's about 8 to 10% of used car deflation that I think we're going to get over the next few months. And I want to get past that because once we get past that, we can have a cleaner read on how the inflation data is actually coming in. Right now, it's a bit of a distortion just because that's based on something that's already happened, in my opinion. The auto supply chains have healed, and that's a benefit that we're going to get. But that's not really the story of where things are going next year because that's, to me, much more a story about growth and how much spare capacity we have in the economy.
And Michael McKee, I'm going to throw that same question at you. What are you looking for in tomorrow's CPI report?
Well, I think we're all looking to see when housing really starts to go down. It's inched down a tenth in the last month or so, and we want to see it go much lower than that. So we'll be watching to see if that happens. One thing you do need to keep an eye on tomorrow is we're going to, for various mechanical reasons, see a rise in the headline rate. There was no inflation last July, so any inflation is going to push it up. What the Fed wants to see is the month-over-month rate remain at 0.2 or less, because that will tell them that at least sequentially, the things Connor's talking about, housing and used cars, are continuing to fall. And